please.
Good morning, everyone. Governor Lujan Grisham. Commissioner Garcia Richard.
Here.
Treasurer Montoya.
Present.
Secretary Probst.
Present.
Mr. Jennings. Mr. Lavender.
Here.
Mr. Rawson.
Present.
Mr. Messina. Mr. Tejas. Miss Allen.
Here.
Mr. Bingaman.
Present.
Madam Chair, we have a quorum.
Great. Thank you so much, Andy. We'll move to agenda item 1B, approval of the agenda.
So moved.
Okay, we've got a motion. Do we have a second?
Second.
All right, we've got a motion from Madam Treasurer, second from Member Lavender. Any discussion on a motion to approve today's agenda? Hearing none, if we could have Andy take a roll call vote on approving the February agenda.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Probst.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Nick's here. Yeah, I'll vote yes.
Thank you, Mr. Tejas.
Yeah, Member
The
Tejas.
motion carries.
All right, great. Thank you. Next, agenda item 1C, approval of the minutes from our January 24th meeting, which were sent out in advance.
Motion to
Move.
approve.
So
Okay, we
moved.
have a motion from the treasurer to approve, second by Member Lavender. Any discussion on the motion to approve the January minutes?
Whoever does them does such a beautiful job.
Oh, nice. Thank you. Is that you, Andy? Who does our minutes?
I do, Commissioner.
Okay.
Yes.
Thank you. Thank you for that.
Thank you, Treasurer Montoya.
Okay. Hearing no further discussion, if we could take a roll call motion on roll call vote on the motion to approve January minutes, please.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Probst.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina, welcome. May I have your vote, Mr. Messina?
Yes.
Thank you. Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 9-0.
Very good. And with that, I'll turn it over to our State Investment Officer, Mr. Moise, for his briefing.
Thank you, Commissioner. Good morning, everyone. Let's begin today with some comments, as we traditionally do, about distributions, which is one of the most important things the permanent funds can do for the state. Over the last 12 months, the funds have distributed $1,277,888,000. Land Grant Permanent Fund contribution from the State Land Office, $205,585,000. And remember, that is lagged 90 days. Our net asset value as of last Friday, February 24th, was $41,896,000,000, more or less 268,000, go on and on. So almost $42 billion as of this morning. It was just a very few dollars shy of 42 billion. New Mexico WTI oil price as of last Friday, $72.87 per barrel, up from $87.62 per barrel a year ago, 87 to 72 over the year. New Mexico rig count as of last Friday was 106, up from 94 a year ago. And natural gas prices in the US have decreased from $4.43 per MCF about a year ago to $3.95 per MCF as of Friday. Looking at the dashboard, if you would, with me, briefly, I'd like to highlight a couple of things. Top right-hand corner, you'll see the land grant and severance tax funds impacts, which I think are, as I said earlier, one of the most important things the funds do. And in FY23, you'll see that about 14.2% of the general fund budget will be provided by the permanent funds. There's some other interesting things on the dashboard, which I will not go into, but they're certainly worth looking at. I'd like to make a few comments about Member Rawson. Lee, I'd like to commend you for your 13 years of service on the State Investment Council on behalf of our staff. You have likely been the longest serving member of the SIC. You've missed only a couple of meetings. You've also served well on our investment and our audit committees. And you've helped us to facilitate several successful statutory improvements over the years you have served. We're grateful for that. As many of you saw in the SIC notes, which Charlie published on Friday, we recently received notice from the Legislative Council Service that Lee's most recent council term has ended, and the Legislative Council has appointed a new council member, Kurt Summer, to serve a term ending March 31, 2027. Kurt's background was also explained in last Friday's SIC notes. His confirmation hearing is to be scheduled after March 6th. So Lee, you will continue to serve, thank you, until Kurt is confirmed by the Senate. And today could likely be your last meeting. That's the reason for my comments. So on behalf of our staff, please accept our thanks for the guidance that you've provided us and for the invaluable work you've done for the funds. And I would ask all of you who are with us on the call this morning to express our appreciation for all the good things Lee has done for us.
If we could just take a moment to have folks share their congratulations and thanks. Member Rawson, I can begin. Certainly you provide the balance that we need on this council, and you have done that for many years. So I very much appreciate your contributions. Thank you. Are there others who would like to speak?
I served with Member Rawson in the first term that I was on 13 years ago. And while we don't always see eye to eye, I think he has always been respectful, and I really appreciate the what you've done for our state in your contributions and being a good citizen.
This is Harold. I'll join in. I really have enjoyed getting to know Lee, and can't say enough about how much I appreciate his perspective. I think Catherine said it pretty well. Kathy said it pretty well. We didn't always agree, but we agreed to be gentlemen about it and to move forward and make things better. So Lee, I'm going to miss you, and I'm really sorry we're not able to say goodbye to you in person. You live down there in that southern part of the state. One of these days we'll see you down there. So thanks a lot for everything.
Mm-hmm.
Madam Chair, I actually know Mr. Rawson more from his days in the Senate than on the SIC, and I didn't always agree with him back then either. But I do know, having followed the SIC over the years from a distance, that he was part of a new SIC that restored the integrity and trust of New Mexicans in the council, and for that, he deserves all of our gratitude.
Madam Chair.
Member Messina.
Yeah, Lee, I want to thank you for having had the privilege of serving with you. You have, over so many years, contributed so much to public service, and I thank you for that. And I thank you for your insights and point of view. Appreciate. We're going to miss you.
Madam Chair.
Madam Treasurer.
Senator, I was looking forward to having debates with you in this committee. I don't know if you remember me working at the legislature as a young staffer and listening to you debate on the Senate floor, but I definitely enjoyed the conversations that you all had and the debates that you had to serve our people, and was looking forward to getting to do that with you through this process. And I'm very grateful I at least had a couple of meetings to serve with you. And I appreciate all the service you've done for New Mexico throughout your years and bringing that different light to the conversation. So thank you very much.
Madam Chair,
Member Bingaman.
just would echo the comments. Really appreciate your public service, Mr. Rawson, and appreciate your perspective, and always learn something from you and the comments that you shared. And so your voice will definitely be missed.
Madam Chair, I think I'm the final person to comment. Nick Tay is here. Just wanted to also share my gratitude and thanks to the senator for all your years serving in public office, both in the legislature and on the State Investment Council. One thing that I will always remember from your contribution is your tedious examination and study of all of the papers and documents that come before the committee. You know, we have hundreds and hundreds of pages that we look at and have to kind of review, and I'm always sure that Senator Rawson will go through every single sentence and study those in depth, and then bring out some very valuable questions and comments on the things that we look at. So thanks for your close attention to all the work that the SIC does, as well as during your time in the legislature. It's been a really great time serving with you, both on this committee and seeing your work in the Senate.
Well said, Member Tejas. We're going to miss our fine-tooth comb.
Well, just to say thank you to everybody, but it's been my pleasure to serve on the council. And over these last 13 years, we had 13 more grandkids, so we're up to 16. The latest was last week, so my wife is looking forward to having a little bit more of my time around here. But you know, we leave the staff and the council in good hands. We've got a great council, and we've got tremendous staff that, with professionalism, that's really moved the council forward. And I would just say, you know, it's come a long way since the days of corruption. And I think we can be grateful for that. And we can present to the public, you know, a solid council that's producing good results. And it's been my pleasure to serve with each of you.
Hear, hear. Thank you. Thank you, sir. Steve, does that conclude your presentation, or?
A few more things, if I may, Commissioner.
Okay.
Thank you for those comments, Lee. You will see item C on my briefing, the dates of the next investment committee and council meetings. And then under that, operations. Your management group here at the office has provided you with a document called Accomplishments 2021 through, 2021 and 22, 2 years. Since April of 2010, we've annually prepared for you a memo outlining the matters the council has accomplished in the previous year, as well as goals for the ensuing year. So the document included in your materials today covers the last 2 years during which this report was not provided. We've now caught up, if you will. As you'll note, the suggested goals are not included, as that would likely not be productive while we take a look back at the prior 2 years. In place of the goals section, we plan to offer the council a document entitled the SIC 2023 and beyond. When you've had an opportunity to review the 21 and 22 report, please let me know if you have any questions or thoughts. You will see under item D2 that we continue to look for new staff members. We're looking for a real return analyst. And we have said a legal assistant, that is what we called that position or entitled that position before Gordon Sellers left. This actually is more of a systems coordinator role. And we have found an excellent person, underline excellent, and we'll be making an offer within the next week or two. Future hires, an investment strategist, and a private equity analyst. Brent may have more comments on that when he makes his report. Charlie will be discussing client and legislative matters, and Brent will also fill you in on our FY24 appropriation request. Before we get to that, as my final comment, I want to commend our team that drafts fiscal impact reports, FIRs, led by Charlie with the help of Dawn Iglesias and Bruce Brown. They do an incredibly good job. And thus far this year, they have written in-depth, thoughtful FIRs totaling 20, and there may be a few more to come. I don't know that there is a team or a person in any other state office that writes fiscal impact reports as thoughtfully and thoroughly as Charlie and his team. And I want to recognize them and let you know that that is one other thing that goes on in our office during a session. Madam
Just
Chair,
a reminder to folks who don't follow the legislative session, those have a 24-hour turnaround time from the time that that request is made. As the treasurer knows from the request made from her office and here at the land office, and of course, Mr. Secretary, DFA Secretary, it's quite an undertaking. So congrats to the staff. Thank you for all of that extra work on top of what you already do.
that's my report, Commissioner.
Great. Do we have questions for Steve?
Let's, if we may, before we go to questions, Commissioner, if we could ask Charlie to comment on what's going on legislatively and with our clients.
Okay, thank you.
Madam Chair, I will be brief. I know we have an extensive agenda today, and there's 19 days to go in the session, including today. A couple things that I want to bring to your attention. House Bill 2 has been passed by the House, and they'll negotiate the terms of the budget bill in the Senate, so things could change. However, there are a couple things to highlight. In the House Bill 2, you have a $850 million general fund appropriation to the severance tax permanent fund. There are more funds as well that appropriations would be made. There's $100 million that would be appropriated to the Water Trust Fund, $100 million to a new Conservancy Legacy permanent fund that the SIC would manage. That's a Senate Bill 9, and I believe it's a governor-supported bill with bipartisan support. There is a Kiki Saavedra Senior Dignity Fund that we would take over management if an associated bill passes. That's about $8 million. $15 million going to the Rural Library Fund, again, contingent on some legislation passing. Senate Bill 26, and this is a big one. passed its first bill or first committee in its second house. It flew through without opposition this morning in House Energy. This bill, it's complicated, but the effect of it would be pretty impactful. Assuming projections hold after money has been transferred to the Early Childhood Fund and to the Tax Stabilization Reserve, excess dollars that otherwise would go to the general fund would be banked into the Severance Tax Permanent Fund. That could be several $1 billion by FY27. It would not kick in until FY25. It would be a massive appropriation long-term to the Severance Tax Permanent Fund. We're watching that one very closely. I want to echo what Steve mentioned about the great team that we have here. Bruce Brown brings not only legal, but financial expertise. And our MVP with her LFC background is Dawn Iglesias. The work that she has done for us is just fantastic. And what an addition to the team. And so, Madam Chair, I'll take questions, but otherwise, back to you.
Yeah, amen. I will second everything you said about Dawn. She's phenomenal. Questions for Charlie or Steve? All right, hearing none, we're going to move to agenda item 2B and turn it over to Mr. Smith for his briefing.
Well, thanks, Madam Chair, and good morning, everyone. Good to see you all. We just have a lot of things going on right now. The economy continues to slow in some important areas, in particular, the interest rate sensitive areas. So housing is number one in that area. Starts are down, I don't know, 27%, I think was the last number year over year. Mortgage apps are down even more. Sales are even down more than that. So we've got quite a slowdown in the housing area. Autos are seeing the same sort of numbers and same sort of patterns. In all the leading indicators, which capture a lot of different measures, a lot of them interest rate sensitive, that's down more than 20% here over the last year. So we're really seeing declines in big areas of the economy. As you know, as we've been expecting and been watching with the federal funds rate increases that the central bank has done. So keeping our eye on that. Markets have been responding. We've got interest rates up. The 10-year Treasury rate, which is probably the most important interest rate on the planet, is now nearing 4%. That's near its highs. I think it got up closer to 4.50 at its peak, but came down pretty quickly off of that. So we've got that going. The stock market's had a pretty nice run so far this year, but it looks like it's more or less of a bear market rally here, and we're starting to roll over. But keeping our eye on that a good bit. So things moving along as pretty much in line with expectations. Our positioning is still very good, partially on portfolio construction, where we've moved a lot of money away from stocks and bonds over the past few years. Just on valuations and lower future expected rates of return, and into areas like real estate, real return, private credit. Those are the areas that we've increased. Those areas are holding up better than the stock and bond investments have over the past 2 or 3 years. So positioning into this sort of environment, we're still happy with where we are. We've also been advantaged by the big inflows. So we've got excess bonds and excess cash in our system, which in weaker market environments has been pretty helpful for us. So sort of a double whammy to the positive side. We're just getting started. Well, first, we've got, as I mentioned to you last time, we've got a very extensive spring macro package for you. As you know, we try to do all our macro work with you in the spring, usually starting February, March, and ending up in June with our macro work. So a big package this year. Hopefully you'll enjoy the presentations and things. We're working hard. The strategy team is as big as it's been over time. So getting lots more done in that area and high quality work there. We've gotten a start on the annual investment plan, which I know you look forward to seeing every year. This one's going to be more extensive. We're bringing back the portfolio analysis section. Last year, the inflows just flooded our models, so we took it out because our numbers weren't making as much sense as they had in the past. But that's coming back, and we'll be analyzing all of the funds rather than just severance and land grant. So that'll be a much expanded section. We're going to bring to you an analysis of expected future inflows, something we haven't been able to do in the past, but now have capability to look at that a little bit harder and bring you some quality reports there. We'll be bringing you a much better forward pacing program. So a number of our growth-oriented funds, particularly the land grant, has almost 50% allocation to the private markets. We'll be bringing a much more extensive future pacing analysis to you to get you more familiar with how that works and how it's going to look going forward. So lots of additions to the annual plan this year, in addition to the macro piece that we do each year, and some of the asset class work that winds up in that report every year. Some of the themes this year. I think we're paying much more attention to volatility going forward. We're paying much more attention to uncertainty going forward. As we've discussed with you in the last couple of annual investment plans, we've just simply turned the corner from 40 years of falling interest rates, rising equity multiples, excess liquidity in the system since about 2008. 0% interest rates and quantitative easing, all that stuff is over, at least for now, and we're very much in a new environment here. So I think we're going to discuss much more about potential for volatility in the markets, and uncertainty about how markets respond to this different economic environment, but also opportunities. We think the door's open to new opportunities for us, not only from our asset allocation perspective, but also from the individual investments that the asset class directors shake the bushes and find. So we think there's some exciting things going on there, in addition to maybe a little tougher environment without 0% interest rates and quantitative easing supporting just about everything. So I think overall, we've got a good package coming in the spring, lots of section. I think we're positioned well for current economic environment, and we expect the current economic environment to continue here for a little while. We need to get through this cycle. We need to get through a recession just to clean the books and get into a new cycle. Once we do that, I think we'll have a much rosier outlook for you. But until we get into the early cycle of the next expansion, we still have some more work to do in terms of being cautious and sort of watching what's happening with a much closer eye. So with that, Madam Chair, any questions, any discussion you'd like to have, we can do that.
Questions for Vince? All right, Vince, if you'd like to turn it over to RVK.
Absolutely. Yep.
Okay, great. Thank you, Madam Chair, and good morning, everyone. Today in your packet, we have the fourth quarter executive summary that we'll plan to review. As always, we'll start off on page 26 of the meeting materials. That should be your capital markets one-pager, hopefully providing some context about the fund performance that you'll hear. I think Vince already provided a great lead in terms of what's happening in the economy, so we'll try to add a few comments there. If you're looking on page 26, it's page 3 of our materials. You'll see a market performance box in the bottom left, and there, as you're scanning across the different asset classes, I think one thing you'll notice is that equities and fixed income certainly delivered better results in this most recent quarter compared to prior quarters, although that's not a great achievement considering how bad 2022 really was. And as part of that, market volatility, to Vince's point, has been high and continues to be elevated even into this year, and we expect that to continue for the foreseeable future. So despite this better quarter that you're seeing here, positive returns, double digits, in some cases, particularly for non-US markets, the calendar year returns still quite negative for most investors, particularly those that tended to be more heavily exposed to publicly traded or traditional assets namely equities and fixed income. Although there were some areas of better returns, of course, and as Vince mentioned, you've been thoughtful about rotating out of these very expensive asset classes, more susceptible to potential sell-offs, and into more income-producing assets that are tied to inflation in other areas. So that's been working well. When you look at this most recent quarter, I think another thing you'll notice is non-US equity exposure outperformed domestic. That was a nice change, and in part led by a softer US dollar. The private market exposures here, and you'll hear about that from your specialty consultants, Townsend and Mercer, a little bit later in today's agenda. We're starting to see valuations, of course, adjust and returns normalizing a bit from very high marks that we've seen for some time now, and that's going to flow through as the lag nature of those asset classes catches up. Global equities, and I've mentioned this in the past, but I think as we round out the year, it's helpful just to reframe global equities as you're looking at that on a holistic basis, both non-US and US, down about 20%, fixed income right around 13% over this last year. So 70-30 portfolio would have experienced an 18% sell-off. There's been certainly after a decade plus of liquidity and easy money monetary policy, created an environment that certainly was very conducive to those asset classes. But I think this environment proved that diversification really still has a place. And when you compare that 18% sell-off to land grant, which was down less than 7% for this year, that's a meaningful difference in terms of downside protection and a testament to a more diversified approach. Sir.
Matthias?
Yes.
May I interrupt for just a moment? Would everyone please go to mute? We're getting some odd pops in the background. Thank you.
Sure. Yeah. Thank you for that comment, Steve. And that flows through as well into your peer ranks across the trailing periods. When Marcia reviews that part, I think that'll ring further true. It's not just against a 70-30, which some might argue is a naive portfolio implementation, although that's not necessarily true. Even across your peer plans, you did a tremendous job in terms of downside protection, and oftentimes that's where you can get ahead, as we've been preaching for a long time. So material downside protection in percentage points, but also when you convert that to dollars, it's hundreds of millions of dollars of downside protection. And so that's very noteworthy. This level of volatility absolutely is a focus for us collectively, and has been a challenge for a number of different reasons. Certainly maintaining policy allocations, in some cases for institutions as markets are moving quite rapidly. The private side a little bit slower to catch up. That's not necessarily a bad thing, but a function of really just how the markets operate, but does present some tracking error relative to your policy targets that I think is healthy to recognize and be aware of. I think in your case, that high class problem that we've talked about in the past of having these very meaningful land office inflows has been a net benefit for sure, but still presents a bit of a challenge for staff, I think, to get those dollars deployed across the asset allocation. So, but again, I think there's lots of effort being done to make that happen as best as possible. In terms of the overarching capital market themes, nothing really has changed too much in terms of immediate focus. These are more long run issues in terms of central bank action, what's happening there, inflation data, obviously a lot of eyes on that. Economic growth has continued to be an area of focus, and then we still have geopolitical tensions, which sort of are more in the background at this point, but still very real and present in their own right. So recession concerns remain for a whole host of reasons. And for that, I think we have to be mindful and cautious to make sure we're positioned appropriately. Vince talked about rates a little bit. You can see that on the bottom right hand side of the chart here. That's the yield curve at different points in time. The 2 and the 10-year spread is one that's often compared and tends to be referenced as a recession indicator when you have inversion there. Well, we certainly do now, and that has continued. When you compare that line from just a year ago, so the green line at the end of this year, the yellow line is a year ago, very substantial difference, not just in the level of rates, but also the shape of the curve, and that has extended into February.
Matias, just 1 second. It looks like it's coming from Christopher Rodriguez. Could you mute, please? Thank you. Sorry about that.
No, thank you. I appreciate that. So a lot of these trends have continued into this year, and we'll have to keep an eye on it. But certainly, while this has presented a challenge for fixed income, more recently there's also opportunities that are being presented that Vince has alluded to. So overall, still offsetting area probably is a relatively resilient labor market, although things are slowing a bit there. Unemployment still quite attractive at record lows essentially, but we are seeing, of course, like everyone else, increasing layoffs and just less frothiness in that market overall, which may just translate into slower wage growth for the foreseeable future. But as we look at this holistically, we think you're well positioned. We are going into this more macro season where we look at capital market expectations on a go-forward basis, your asset allocation, and we'll bring that to you as early as next month for, I think, a really interesting discussion. Fixed income is probably the area that moved the most, and again, that chart on the bottom right, just seeing how much those rates have moved up is a primary driver of that. Just not just on a absolute basis, but on a percentage basis as well. So we'll present you with those changes and forward expectations, but think you still have a really good strategy for this environment. So in the interest of time, I'll stop here. Happy to take any questions or comments. Otherwise, I'll turn it over to Marcia for a few comments on your fund performance.
Let's head to Marcia's presentation and then we'll take questions after that.
So Lee, thank you, Lee. I can truly say with all honesty that you've made us better consultants. You've challenged and asked questions, and that always makes us, we think, better consultants. So thank you for being an active.
Marcia, we're having a hard time hearing you.
Okay. Is that any better?
Not really.
You see what I can do here. I'm trying. Is that better? Is that better?
I can hear you fine, but some folks are having trouble.
Matthias, can you hear me?
Yeah, I think it's a little bit louder. Maybe just try speaking up a bit.
Shouting? Okay. Well, I don't know if Lee heard, but I want to thank Lee again for being an active council member and helping Matthias and I be better consultants to the council, and appreciate all your service. With that, I will take you to page 29, and this is looking at your allocations as of December 31st. This is on the land grant on the left, severance on the right. This is really no different story than we've seen for quite some time, where you have overweights to core fixed income and to cash because of your high class problem of receiving a lot of contributions from the land commissioner's office. A couple things I'd point out due to a presentation that Vince made. You'll notice that in the within range column, you'll see NA. Just a reminder that this denotes or reminds us that there was a suspension in target limits due to the cash flows, and that's what why we're showing that there. So with that, no different look there. On the following page, on page 30, we look at the allocations for the other funds. I just want to note here that you'll see the difference in returns for those funds that had less exposure to public equity performed better for the calendar year than those that had a higher allocation to public equity, as you would suspect. And with that, we'll go to page 32 and go to page 32 and look at the policy review for the land grant and severance tax. Just a reminder that in your investment policy, you look at, you judge your returns per your policy against their benchmarks based on a 5-year periods. For the 5-year period ending December 31st, both the land grant and severance fell below their policy index. Land grant was below by 11 basis points, severance tax a little more. But if you look fiscal year to date, and then if you look longer beyond the 5-year period to the 7 and 10, you'll see outperformance versus that stated investment policy benchmark. Any questions there? Okay, so now we'll just look at the attribution, and this is for a quarter. And as you've heard Matthias and I say, and certainly Vince, that your return, most of your returns come from your strategic allocation. You'll see in the upper chart that for the quarter, that was a positive return, and the blue line did a little bit better than the green. The green is your actual performance. The blue was your strategic target allocation at the stated target using your benchmark returns, not all of which are investable. So you trailed, in this chart explains why you trailed slightly for the quarter. Down below in the blue columns, again, you'll see most of that return. SAA stands for strategic target allocation. So your allocation drives the return, but you had a headwind under tactical asset allocation. That's a TAA, and it's not really tactical. All it is saying is that you were not on your strategic target allocation exactly at all times. And you know this with the cash flows, having more in fixed income and cash during the period, a bit of a headwind, but also being underweight to, as Matthias said, non-US equities and public equities domestically did better. And you were underweight to those asset classes. So that was a headwind for you, and that's reflected in that negative 0.36. The next is being away from your benchmark. So the SS just really means that your asset class structured, did they perform per their benchmark for the asset classes? And that was a slight positive. But for the quarter, you'll see that manager value add, the final column, was a bit of a headwind. So being away from your target wasn't made up from your manager performance for the quarter. But if you go to the next page and look at the 1 year, you can see kind of the same story with the yellow line. Not being at your target allocation was a negative for you, but the manager skill or manager value add and the structures of your asset class both added value to your return. Any questions there? Next, we have the same information for the severance tax, but I'm now going to take you to page 41. And again, it's not an objective. It's not stated in your policy that you want to do better than your peers, but it's something we talk about. And it's something we talk about when we're structuring your asset allocation, that you want to protect on the downside, be somewhat defensive, And the highlighted areas are how you ranked against these different universes. All public plans greater than $1 billion is the universe that we typically use, and the numbers highlighted in blue are how you ranked as of 12/31 for each of these time periods. Now, certainly for the quarter, you can see you ranked below median, and that is explained by, it was actually a good quarter for public equities. So you have a below median rank, but if you go longer term, for your fiscal year, you're in top quartile for the calendar year ended 2022, your top decile in the 7th percentile across the board. To 19th percentile for 5-year, and then at the 10-year in the top third. So having that positioning has served you well when we compare you to the peers, especially in a period that public equities in particular did not perform well. So being diversified, and as Matthias was talking about, a 60-40, 60 equity, percent equity, 70% equity portfolio, where many of your peers stand, you did quite well against that. So wanted to point, and then the different universes you can see for very large plans and then all public plans, the ranks show well in each of those universes. We also then take on the following page, page 42, this is looking at that same universe greater than $1 billion and public plans, and looking at 5-year rolling period. So per your policy, it's not an objective how you rank against peers, but we use the same time frame that we use against your benchmarks, and looking at each of those 5-year rolling periods, how you ranked. Really, since 2014, you've had far more ranks above median. We've talked about this before. We wanted to keep you away from being number 1 to being 99. So just having that consistent above median return in the long run results in strong performance. You can see you had a few drops below median, but for the most part, you've fallen above median each of those time periods, and that is reflected in, for the 10-year period, ranking in the top third. Looking at that a different way on the following page, on page 43, we look at the 5-year rolling rank for your Sharpe ratio, or your risk-adjusted return. And in this case, you can see that really since 2014, you've been above median, and for most of that time period, you can see you've been in the top quartile. So that's a great place to be, and is a reflection of the hard work and diversification that you've done over this time period. I have the same, very similar information for severance, but now I'm going to take you to page 46 and look at a little bit more total fund information. Let's look at the top left, and this is a risk return chart. The yellow triangle is the land grant policy index. Right below that is a land grant total fund, which is a green diamond that you can't see because it's below the yellow triangle. And then severance is shown as well with the blue and orange. But just let's talk about land grant. Here you can see that against those peers, each of those gray dots are a peer portfolio, a peer fund. You have low volatility, so you have well below median volatility, but above median return. So you fall in that northwest quadrant where you have above median return and below median risk. If we look at that in percentage wise, you had for the period, for this 5-year period, you returned 122% of the median return, and you got there at only 75% of the volatility. So that's exactly where you want to fall, in that northwest quadrant, having a return above your peers, but getting there with less volatility. So you go down to the 10-year, right below that, you can see the same story is true. Inching its way above, you've moved up. And it's now reflected in that 10-year number, as we showed before, again, ranking in the top third for the 10-year period. Any questions there? With that, I'll be very quick on page 48. We look at the composite, your asset class composite returns. You have your specialty consultants here to talk about your privates. Just to make a couple comments about your U.S., non-U.S. and fixed income. As I go through, let's go to page 51. But I will say that there were no manager changes or additions or terminations in to your lineup for the quarter. So you've been stable. On this page, on page 51, you can see the performance in the table against your policy expectation. You want to beat the Russell 3000 over, again, a 5-year period. You can see, as you know, you didn't do that longer term, but adjustments have been made to the portfolio. And for the shorter term quarter fiscal year to date, you've been ahead of that benchmark. Just want to point out here that also the large cap, U.S. large cap composite historically has been where you've trailed. The small cap index, you can see, has had nice outperformance relative to its benchmark. But again, transitions to the portfolio, so we expect to be closer in your performance to the benchmark. With that said, on the following page, on page 52, on that risk return, you've against your peers that with U.S. equity allocations, you can see you've been about median in return, but lower volatility than your peers. Not quite in that northwest quadrant, but at median with less volatility. Next, I'll take you to non-U.S. equity here again, and this is, let me say, this is on page 56, but there were no manager changes, additions, or terminations during the quarter. Here you can see yeses that you outperformed your policy expectation for non-U.S. equity. You can see it across the board. This portfolio has been successful in that outperformance, and then we show you the developed markets and emerging markets composites as well. And then lastly, going to fixed income, Tom will be talking to you about core and non-core fixed income today and some changes he's recommending. But with that said, on page 61, your policy expectations for these portfolios with the benchmarks that you currently have, you've met your policy expectations for both the core and non-core portfolios. But more to come there, and some changes that Tom's going to put forward today. With that, happy to answer any questions, both Matthias and I, and thank you for your time.
Great. Thank you, Marcia and Matthias. Questions on this report from council members?
Thank you.
All right, hearing none, we're going to move into our quarterly performance reviews, and we'll start with Mr. Sable. And then if you could make your comments and turn it over to Townsend, that'd be great. On real estate, agenda item 2D.
Thank you, Madam Chair. Today from Townsend, I have joining me Seth Marcus, Rob Coaches, Stephen Hertenstein, Teddy Grodzinski, and Malcolm Blake. The content in your board book for the PMR begins on page 99. Despite weaker short-run performance, the real estate portfolio has outperformed its Odyssey benchmark by 130 basis points net over a trailing 3-year period, and has also generated strong performance for the 5 and 7-year trailing investment horizons. A couple of key drivers, and those drivers were mixed over the course of the past quarter. NOI growth remained pretty strong, especially across industrial multifamily sectors. The benefits of the strong NOI growth were more than offset by rising cap rates, so a valuation impact in the market. We've seen secondary markets, so the public REITs, be particularly sensitive to cap rate changes tied to interest rate moves And while they've sold off substantially, the REITs have more broadly bounced from the bottom. Nevertheless, there's still a significant gap between the performance of public and private real estate assets. And that would suggest that, at least for the next several quarters, the private marks in real estate will probably be under pressure. With that quick and dirty set of comments, I will hand off to Seth for his commentary.
Thanks, Keith, and good morning, everyone. I do want to take just 10 seconds here and thank Mr. Rawson for his service and guidance to the SIC over the course of his 13 years with the council here. Your integrity, your views have put the council in a much stronger position than it was when you started, which is, I think, what we all strive for as we participate in events like this. So thank you for your service. With that said, I'll jump into the PMR. I do want to introduce. Keith mentioned a couple of new colleagues on the phone today, both Rob Kochis and Malcolm Blake. Rob's a partner with Townsend. He's been with Townsend for over 25 years, and Malcolm's an associate. We wanted to add to our team here that services the SIC, given the robust size of the portfolio and the real return and real estate combined exposure. So with that said, the PMR here starts on with performance on page 102 and of your diligent report. And as Keith mentioned, and you've heard from others, this is the third quarter performance. As a reminder, we do a bit of a deeper dive and include individual fund summaries at year end. So we'll have that in the annual report, which will be available in a few months. But meanwhile, the third quarter was a quarter we experienced slight negative total performance to the tune of about 20 basis points. You see that on slide 102. The breakdown of this was 80 basis points of income and about 90 basis points of negative valuation adjustments, and then 10 basis points of fees. Similar to our discussion in the second quarter, the portfolio does slightly underperform the annual benchmark by about 180 basis points. However, outperforms over the policy benchmark over longer time periods, including that 5-year period of in excess of 100 basis points. Short-term performance, really relative to the benchmark, is primarily due to valuation timing and general market volatility, leading to asset value adjustments. The 19.2 net return that you see here remains significantly above expectations and historical norms. That number will likely be in the 7 to 9% range annually over a longer market cycle. And really, that was driven by a couple very strong quarters. The fourth quarter of 2021, the first quarter of 22 really drove that outsized performance. And as Keith mentioned, we do anticipate that to come in a bit. I'll talk about some more near-term numbers here in a moment. As mentioned, the short-term quarterly performance is primarily due to short-term underperformance is primarily due to valuation timing, as the broader market began to see write-downs about a year ago. And they're starting to trickle through to the real estate portfolio and their performance here. Throughout 22, we saw bigger macro events impacting all asset classes. Private equity real estate tends to lag the broader market by about 12 to 18 months. And now, coinciding with that time frame, we're starting to see the negative returns in the third quarter and into the fourth quarter. To that point, we don't have fourth quarter performance in here, but I do have some numbers for you. We anticipate further write-downs in the fourth quarter. We saw a negative 5.8% write-down from the index in the quarter. That was offset by about 80 basis points of income, so positive income offsetting that return. So a negative 5% total return in the fourth quarter. In conversations with managers, valuation firms, different property types, specifically, we're seeing really cap rate expansion, discount rate expansion in the 25 to 40 basis point range across most property types in the fourth quarter, and that led to that valuation decline. Office and industrial were the lowest performers. Retail was only down slightly. This is largely due to past write-downs having a higher and already taken into account, but also having higher in-place yields, in-place cash, and we'll talk about the income in just a moment on another slide. On the alternative sectors, we did also see write-downs in some attractive property types like life science and medical office due to lower in-place cap rates. But storage and student housing did show some resilience. So we're seeing a kind of a mixed bag of performance, but really anticipate write-downs into the current year. So what does this mean for our portfolio going forward? Our sector weightings and technically and specifically an overweight to core should provide us with downside protection. So further, I stressed this in the past, but slide 103 really highlights the income component that real estate generates. As shown, regardless of valuation adjustments year in and year out, income has both remained positive and resilient on an annual basis over the life of the portfolio. As a reminder, the first 5 years are a bit of an anomaly because there was no core exposure prior to the existing SIC in place, your staff, consultants, et cetera. So there was no core holdings today. Today, we are much more balanced, actually overweight to core, as I mentioned, and generating really strong income returns to the tune of about 4.5% since the 2011 rebalancing, and significant outperformance from an appreciation standpoint of 10.3%. The last comment I'll make about the broader market really leads into a recommendation we're going to make later on the agenda, is that we do think that opportunistic strategies that have a track record and capabilities to execute through market cycles like we're experiencing today are attractive opportunities to place new capital. So we'll talk about that as mentioned later on the agenda. Moving back to the presentation on slide 104, excuse me. Throughout New Mexico's collaboration with Townsend, we've stressed the fact of driving down fees and fee savings. And here we are highlighting that over the course of an annual period, we've generated approximately $3.1 million of annual fee savings from 17 different managers. This is a significant amount, and is shown that in the performance charts that we're not compromising on the quality of managers just for a lower fee, or don't just go with a low cost provider or manager. We find very high quality opportunities and then negotiate fees hard for our clients. We're able to do this because of clients like yourself who are large, sophisticated, and active in the market, as well as 100 other mandates across the Townsend platform that we utilize our strength as in the position in the industry to negotiate terms. On the topic of allocation, and this is peppered in a little bit on some of the commentary on slide 105. We are at quarter end, we are about 11.8% of total plan assets relative to a 12% target. This is more or less consistent quarter over quarter and really right on target. Being at our target is something that this group should feel pretty proud of, given it's taken a lot of patience, reviews, approvals over the course of our tenure here. Over the last 10 years, really since 2011, we've made 12 core commitments, over 1.8 billion in commitments, and then 47 non-core commitments, totaling $3.5 billion. So from a portfolio construction standpoint, we do remain overweight to industrial by about 4%, as well as alternative property types, we're overweight by about 5%, and then an underweight to office and retail, and that's all as designed. The sector we talk about regularly for increasing is multifamily, and there we've made a few dedicated commitments last year, and we believe the current portfolio weighting will increase over time. It's actually increased, and we're just about 2% below target at this point. We believe the current portfolio weighting is very well positioned in both a contracting economic environment like we're experiencing today, but also when we see growth again coming out on the other end of this. As always, there's a lot of other slides in here and different metrics. The one last page I'll flip to is 108, and this is the PME, or the private market equivalent slide. And it looks a little bit funky. That's a very technical term because of the volatility we've seen in the public market. So given the write-downs, you can see that the significant outperformance in our portfolio, highlighting one of the many reasons we invest in the private markets. At the same time, this is a point in time, and this is something we include in your performance report every quarter, and something that we'll continue to highlight and track on an ongoing basis as we're starting to see the write-downs here in the real estate portfolio. So this chart will not look this dramatic, I'd say, going forward, but we did want to highlight that here in the current environment. I'll stop here. As I mentioned, there's a lot of other slides in here, and happy to address any questions.
All right. Questions from council members on our real estate PMR? Hearing none, we'll move to agenda item 2E and turn it back over to Mr. Sable and then Townsend for our real return PMR.
Thank you, Madam Chair. The content for the real assets and real return PMR begin on page 135. Just by way of reminders, our real asset exposure is comprised of two buckets: a real assets bucket, which is about an 80% weight, and a real return bucket, which is about a 20% weight. Inside real assets are typically private equity type investments in agriculture, timber commodities, energy, and infrastructure. On the financial assets bucket, we have exposures to energy equities, public energy equities through an MLP position, and then a series of debt-oriented real estate investments. Both categories outperformed the CPI plus 300 benchmark on a trailing 12-month basis. Longer term performance has lagged somewhat. Performance differences between the two buckets tend to be explained by the composition of the investments in each of them, with the real assets bucket being largely equity oriented and the financial assets bucket being a mix of debt and highly volatile public equity. Without tipping my hand, I'll just say that these topics and others are going to be addressed in the structure study that's forthcoming in the second half of the year. With that, I'll hand off to Seth for his detailed comments.
Thanks, Keith. Again, here the portfolio the presentation starts on 135. 138 is really the first page of content. The portfolio currently represents about 10.2% of total plan assets, and this is based on market value as of the third quarter, and compared to a 10% target, so slightly over allocated. Similar to real estate, the real return portfolio grew over the quarter, but only slightly. The limited growth was really due to sales in the MLP portfolio. So there was a $100 million sale in the third quarter of 2022. There was an additional $150 million sale of MLPs in the fourth quarter. I'm taking some gains off the table here. These sales will substantially reduce the volatility of the overall real return portfolio, given that MLP public market exposure. And these sales are also anticipated to provide some additional commitment availability for the real asset sectors. The financial assets and the MLP portion of the portfolio as of the third quarter did represent about 21% of the total real return allocation, with the balance roughly 80%, 79% being in real assets. The overall performance that Keith alluded to was stated on slide 139, and the first bar representing the full real return portfolio, the second bar representing just the real asset subset. Given the inflation numbers in our benchmark consisting of the CPI plus 300, the portfolio did underperform most of the longer term periods, although outperforming over the quarter and the 1 year period. As a reminder, and Keith mentioned this, the significant difference is that MLP and debt oriented portion relative to the equity infrastructure, timber, ag, and energy portfolio of the real assets portion. Moving along, I'll focus the remainder of the slides, or the remainder of the slides are focused on real assets. On page 141, we start talking just specifically about real assets, and that is an 8% target within the portfolio. And as of the third quarter, we were at that target allocation. On a dollar basis, the portfolio increased by about $55 million quarter over quarter. This includes distributions from these investments, about $80 million from both sales and income generation from the investments. We anticipate this allocation will increase over time as we do have uncalled capital in a number of positions that will be drawn. On the last, one of the last things to highlight of the strong 12.8% return, which is highlighted on slide 9. You can see the returns relative to that CPI plus 300 index. Each underlying sub portfolio positively contributed. That is infrastructure, that is energy, that is agriculture and timber, and in varying categories. But if you think about how we're positioned today, we are over about 50% to infrastructure. A large portion to energy, and the balance being in the other two. So this performance is really driven by both energy and infrastructure exposure. So the reason I highlight that is if you flip to slide 152, we include our performance or our compliance guidelines and compliance matrix in the portfolio, you'll see that there's a couple things that are technically out of compliance. The performance, as I just mentioned, over the 5-year period, we are slightly underperforming the CPI benchmark, and the other being the infrastructure allocation is slightly above the 50% requirement here. So we're at 50.8%, so about 80 basis points over. And to Keith's point, in the structure study that, you know, as well later this year, we'll be talking a little bit about these ranges and creating a little bit more flexibility, given the opportunity set within infrastructure is a bit more robust than the other asset classes, which is part of the reason for the overexposure. The other reason being that portfolio has grown due to just strong performance. So it's becoming out an overexposed asset class. With that said, that was the summary of my prepared remarks. So, and again, happy to answer any questions from the council.
Thank you, Seth and Keith. Can I just begin with just a curiosity, and maybe this has just never grabbed my attention the way it did today. So on page 155, you start with the market outlooks for, you know, ag and timber infrastructure. Why do we not have energy on there?
Sure. So Townsend, we report on your energy portfolio, but as part of our scope, we excluded energy from our services that we provide you. Though many of those energy commitments and recommendations were made by your private equity consultant. It's not an asset class that we would hold ourselves out as being an expert in. So therefore, we don't offer those services to our clients. Because this is a full real assets portfolio, we do collect the performance and report on it. However, we don't cover the sector very closely.
So Vince, is there some way that we can just see how those markets are and get an update on them?
Madam Chair, yes, we'll let me review the reports that we have. I know we do some energy stuff in Mercer's reports, and as Seth said, they're the primary consultant that recommends those investments to us. So let me sort through this report, see what we have, and we'll definitely make some improvement there.
Okay. Thank you. Madam Treasurer, did you have a question? I saw you.
I did. If you can clarify for me MLP, I'd appreciate it.
Sure. So, sorry, Keith, you want me to go ahead?
That's right, Seth, go ahead.
The Master Limited Partnership?
They are, and this is the essence of it is this is public exposure to energy investments. So these are publicly traded and liquid investment opportunities within the energy sector.
Madam Chair, if I could just add one thing, those investments are primarily in infrastructure. It's primarily pipelines that move liquids. That's what's behind most of those investments.
And those are a pass-through, correct? Like pass-through entities?
I'm sorry, can you repeat the question?
She asked if they were pass-through entities. Pass through.
You don't pay income tax?
That's correct. Most of them are pass-throughs. Would be some that are in the Harvest portfolio that could be C Corps.
Thank you, Madam Chair.
Further questions? All right, hearing no further questions, we'll now turn to our private equity programs. We'll start with our national program. This is going to be agenda item 2F. I'll turn it over first to Mr. Cassidy, and then if you can just turn it over to Mercer after that. Thank you.
I'll pass it along to Richard, but just at a high level, this quarter, the Q3 quarter, there was some currency depreciation in the portfolio at that time. The euro depreciated 6.5%, and the pound depreciated around 8%. Euro denominated funds are a little over 10% of our portfolio, to give you some context, but I would say generally speaking, we're pretty happy with how the portfolio is holding up in a more volatile environment. Part of it is a good chunk of it potentially is our growth equity portfolio is geared towards managers that do more profitable growth and growth buyouts relative to some of the strategies, late stage venture and growth that have been particularly hurt the last year. I'll pass it along to Richard to talk more.
Thanks, Chris. I just want to start out too, thanking Member Rawson as well. We've worked with the council for almost 12 years now, and I remember he was there from the very first strategy presentation that we gave, and we've always appreciated his insightful comments over the year, and just want to congratulate him on his years of service and wish you success going forward. I'm going to start on page 176 in the materials with the slide titled Performance Overview. And I'm just gonna hit on a couple slides to give a sense of what's going on in the performance for both private equity programs. So we're covering Q3 today. We did have another decline in the portfolio in Q3, although it wasn't the same magnitude as we saw in Q2. The portfolio was down 1.9%. We've had 3 quarters now of low to negative performance, which you can see impacting the 1-year number, but it's still positive at 1.3%. And it's actually tracking better than the Burgess Global Private Equity benchmark over that period, which is actually a negative return on a 1-year basis. When you go out longer time periods, you still have favorable performance with the 3-year at 20%, the 5-year returns at 17%, mainly driven by those vintage year 2011 and after portfolios, as the legacy portfolio now has less influence over those measures as it's been mostly realized. From a since inception standpoint, the 2011 and after funds have generated a 17% return, and the program overall has generated a 12.6% since inception net IRR, which equates to about a 3.9 billion gain since the inception of the national program. I'm going to skip ahead 2 slides to show the changes in net asset value. So this is page 178. And this graph really shows the changes in net asset value over the last 2 quarters. The net asset value overall dropped from 3.7 billion to 3.6 billion due to distributions exceeding contributions, and then also the net loss for the quarter that we previously talked about. We did actually see a gain in growth strategies in the quarter, as Chris was talking about, which was kind of an anomaly in the industry because a lot of the growth strategies that did focus on pre-IPO or IPO companies were hit rather hard during the quarter. Although the size of that gain was not enough to offset the losses in the other 3 sub-strategies that we track. We did see a negative impact from Europe-focused funds during the quarter, which were impacted by multiple factors, including declining values in the portfolio, which can come from company performance or a decline in valuation multiples. But performance is reported on a US dollar basis, so the SIC performance also had an impact of a weaker euro. However, it looks like this will reverse in Q4 with some of the preliminary numbers that we're getting in. We also had a sizable gain from one fund, which had a public company that was acquired by a strategic company for more than double its publicly traded price. When you look at the distributions have exceeded contributions for both quarters, which is a sign of strength in the portfolio that we're still getting realization activity despite the weakness in the overall market. And actually through the end of 2022 for the full year, distributions exceeded contributions by 99 million. So the portfolio is still generating good value despite the volatility that we're seeing in the public markets. I'll skip the following slides due to time, but the portfolio is benchmarking above public equity benchmarks on a public market equivalent basis. We're generally above median on a by vintage year basis, and the portfolio is all within strategy targets. With that, I'm happy to take any questions about the national program that you might have.
Questions from council. Madam Treasurer.
Out of curiosity, on page 178, is it standard for you to have more distributions than contributions, or is that just for that time frame? Or is that the standard?
We expect to receive more distributions from contributions right now, given the age of the portfolio. But with the market volatility, what tends to happen when we have down markets, because there is some correlation between private equity and public equity, is distributions tend to decrease. But we've been seeing a good number of distributions in the portfolio through the year. So it's showing that the portfolio managers are still finding buyers and ways to realize value in the portfolio, which is a sign of quality in the portfolio.
I would say it's not necessarily normal per se. There's there's a lot of, comparable funds that are, denominated out at the moment where they're not receiving enough distributions to fund capital calls. The value of the rest of their portfolio and public equities, bonds, other investments has declined, making their private equity portfolios a larger percentage of their portfolio and maybe putting them out of the market. Thankfully, we're not in that position. We weren't in that position going into all the inflows that we've received on the oil and gas side, thankfully. And it's really, it's a sign of health. We're happy to see it because it does show that our managers are able to realize value and we don't have a lot of unrealized. It's just kind of sitting there.
Something I was curious about on the vintage portion, it seems that your vintage aspect has really assisted you in the overall total amount. Now that we're in a weird, volatile situation with an inverted curve, are you guys factoring that into in 5 years from now, what to expect, or have you thought about that? It's just curious.
Madam Chair, go ahead, Chris.
Go ahead, Richard.
Well, Madam Chair, it's Vince. I can weigh on that a little bit. Yes, we do. So you'll see next month our RVK's long-term capital market assumptions. You'll see changes, to those. I think probably more importantly is we make money in a different way in private equity than we do public equity. So public equity is often dependent upon the multiple to earnings. So how much investors are willing to pay for each dollar of earnings that the companies in the public traded markets make. So a dollar comes in at the top of a public company's income statement. It kind of works its way through a pretty efficient financial model, comes out as a few additional cents of earnings. Then a multiple gets applied to that, and up goes stock. So that's generally how we make money in the stock market. Private equity is different. Our managers there are buying companies, improving them, improving the middle of the income statement, so to speak. So it's not so revenue dependent, and it's not so multiple dependent as the public traded markets are. So I think that's some of the differences that you're seeing there.
And I think the next couple, when we commit capital, it's invested over, say, 2 to 3 years on average. So the capital that we're beginning to commit, knock on wood, will hopefully be deployed in a fruitful environment with lots of investment opportunities, given what Vince talked about, where potentially at the tail end of a recession or in a environment where financial assets are generally cheaper, it'll be a better investment opportunity for the managers we invest in. So we're hopeful that 2000. Really, this year's kind of tough, but 2024, 2025 is going to be quite an interesting time for investments for the firms we're investing in.
Thank you, Madam Chair.
Any further questions on the national program? All right, we're going to round this section out with our hearing on our New Mexico private equity quarterly report. That's agenda item 2G. I'll turn it again over to Mr. Cassidy and Mercer.
I'll hand it along to Richard, but one note at a high level, this portfolio remains relatively concentrated. So there's a number of large positions that really affect the performance quarter on quarter. But the performance over the last quarter and year kind of reflects generally what is occurring in the venture capital world. But I'll pass it along to Richard.
Thanks, Chris. And I'll do another kind of quick overview to give you a sense of what's happening in the quarterly performance. I'll start on page 203 in the materials with a slide that really shows the time horizon performance by category of funds in the New Mexico program. Quarterly returns were down 2.5%. As Chris mentioned too, I mean, venture capital has been down this year as well. So, I mean, it is tracking what we've seen in the broader venture capital. Quarter three was not down as much as quarter two, which was a negative 6.3% quarter return. But you can see that the lower performance has impacted the 1 year and 3 year, which are both negative performance at a negative 6.9% and negative 0.4% respectively. Over the last year, all categories except the Recovery Fund and Catalyst Fund have really seen negative performance. And when you go out to the 3-year number, negative performance has really been driven by the co-investment funds, which were down about 6.4%, while the 2016 and after fund commitments were up almost 20%, but they didn't really have much influence in the overall performance since they are newer commitments. Since inception, the program has generated just under a $40 million gain, which is largely driven by the fund investments, which equates to a since inception net IRR of 0.8%. And from a commitment activity perspective, I mean, we were quite busy in 2022. We had 150 million of commitments to 4 managers, and we've been working on a couple of fund opportunities that we plan on presenting in a future meeting. Skipping ahead to page 205 in the materials, we'll walk through a similar graph that shows the net asset value changes. The net asset value of the New Mexico program declined by about 13 million from 448 million to 435 million. Similar to the national program, one of the drivers was distributions being greater than contributions, in addition to the portfolio loss that we saw. We actually had 5 funds report gains during the quarter, but 25 funds report losses. And the size of the losses were just greater than the gains, particularly with the co-investment funds and the fund investments. And the co-investment funds in particular continue to be impacted by a sizable publicly traded holding whose price just continues to decline in a weak public equity market. Regarding distributions, you'll see distributions continue to exceed contributions in quarter three by 2.2 million, although it wasn't as large as the difference that we saw in Q2. And for the full year 2022, distributions actually exceeded contributions by over 25 million. And this was really driven by distributions from the Recovery Fund, both interest payments and then also the repayment of principal from loans made from the Recovery Fund occurred during 2022. We have some economic development statistics on the following slide. There wasn't really much change quarter over quarter in the statistics. There wasn't a new New Mexico-based investment during the quarter. The job numbers increased slightly, but not meaningful. So I'll just end my presentation there and happy to answer any questions that the council may have.
Thank you, Richard and Chris. Questions on our New Mexico private equity program?
Madam Chair, John Bingaman here.
Member Bingaman.
Just a question either for Richard or Chris on 204. I mean, is the right, we have the 9% target, right? The council had made a policy decision back in 2019, I believe, to target 9% of the 7 Sex Permanent Fund in this program. Looking at 204, I mean, I think the way to calculate where we're at today, if I understand correctly, is taking the contributed dollars, the dollars in the 689.7 minus the distributed 294.1. And so that means we're at about 395 million. And so I think that's about 5% of NAV. I guess, we've seen some real growth in the overall fund corpus just recently. But could you talk to, the viability of hitting that 9% target and how to sort of accelerate, investments in the program to get up to that target? Recognizing last year was a good year for commitments, and commend you for, what you're able to do with that American Frontier Fund. Just wondering how we can continue to drive, those type of large commitments in the program, or a large number of smaller commitments that will get us closer to that target.
I would say we're cautiously optimistic about what we're seeing. I think we have in line with what we discussed with the Frontier Fund, we have a kind of a differentiated ecosystem here, which has unique opportunities because of the types of technologies that are coming out of our labs. So I think, you know, from that angle, I think we can see opportunity to, continue to invest, capital. I think given the early stage nature of this program, a pacing number for any year to get to that 9% is lower than it would be for our main program, which is more buyout oriented. But we're cautiously optimistic about the pipeline that we're seeing at the moment. We have a couple investments in the near term pipeline that we're quite excited about. And then a couple others that would be probably a little later in the year. But I think people are recognizing that our ecosystem is providing a lot of unique kind of companies and technologies. So, I think we're cautiously optimistic, I think is the way to frame it. I keep on saying that.
Great to hear. Thank you for that question, Member Bingham, and it prevents me from sounding like a broken record, and I appreciate it.
Thank you.
Member Allen. Oh, are you finished?
I am. Yep. Thanks.
Member Allen.
So a kind of a broader question about economic development and growth of businesses in New Mexico. A friend of mine heads the Council on Competitiveness in DC, and they did a study in Albuquerque comparing to other tech center areas. And the two kind of gaps they found were, one, having enough people that had business background or MBAs or knew how to take a business from inception to growth. The other was not enough venture capital or private equity capital to invest in the businesses. And I've been involved. I was on the board of RiskSense, which did sell. But I know it seems like we have trouble creating and growing those businesses I know a number of companies that have actually moved to Silicon Valley or to New York to be able to get the capital that they need. And I know some of you know, John, they had an article in the paper Sunday, I guess, on John Rizzo, who is trying to develop this as a technology center in New Mexico. I, for one, am hoping that we can focus on cybersecurity. But what's the bigger problem that you see? I mean, why is it that we continue to have trouble finding good businesses and helping them to grow? Is it those two things, the lack of capital and lack of people that have business background, or what are you seeing?
I think when we discuss the Frontier Fund, when we're not the only ecosystem in the middle of the country that faces some of these challenges. One of them, and an important challenge, is the necessary C-suite to take the technology and make it into a company. That's a challenge, I think, outside of the coastal, all the names of the coastal places that the main ecosystems. That's been a big challenge. And I think the nice thing about what happened with COVID, if there is a nice thing that occurred out of it, is this recognition that maybe businesses can be started elsewhere, hybrid work. So I think there's some positives on that side. I also think that venture capitalists and private equity firms generally are looking not just in their ecosystems, they're looking at other regions for opportunities, and it's something that we see when we speak to managers all the time. It's a competitive world, and if they find a good opportunity in their space in a particular geography, I don't think people are quite as hesitant as they may have been 10 years ago. So I think there's some macro trends that are helpful, that there's a growing recognition we can't build businesses in only a small number of cities in the United States, that more is needed. So there's kind of a macro trend, I think, that's potentially helpful for us the next decade. But it's well, I'm the first to say that it's not going to be that easy. But I think we can do our part by, committing to things like the Frontier Fund, where people are excited to work with our ecosystem, and it's a natural thing because of what our ecosystem is producing in terms of technology.
Yeah, our focus is really high quality managers, trying to get the best managers with expertise that can help these companies grow. But yeah, the SIC is part of a broader ecosystem, so we do need support from other areas of the economy. Like you mentioned, employment. If there's not enough people for a company to hire and they're growing, they are going to have to go somewhere else to hire those people. But we're hoping that the Frontier Fund, you look at the background of those people, they have experience in building companies, and that can help get the New Mexico program some successes. And then it creates a virtuous cycle where people are naturally coming to New Mexico to try to find the next opportunity because they don't want to miss it.
It seems to me that one of the things that we focused on or haven't focused on that would be important is that late seed and early Series A money is one of the real problems in New Mexico. What we see is that, and that's a long time story. Company gets started, great idea, has some legs, starts to generate a little bit of income, and then needs more money to expand and grow, and they can find that money on the coasts, and so they leave. And one of the things that I would hope we can do is figure out a way to help that late seed and early Series A money, figure out a way to get that money in the hands of the worthy companies. I think that, to me, becomes our biggest challenge. And I think that things are in great shape right now on a relative basis. And we've become more involved. America's Frontier Fund was awesome, and I think that hopefully we can do more of that.
I also feel like the state needs to have a strategy. And again, I'm going to use cyber as an example because that's my field. And there's 20 jobs for every person out there that has a cybersecurity background. Same with data analytics and kind of the risk management area. And it seems like we have to look as a state at funding is a piece of it. And I would agree with you that with the early stage funding, we don't have, or it's minuscule. It's like 25,000, which does nothing. But we also have to have workforce training, and our colleges and universities and community colleges have got to offer the courses in cybersecurity. And then you've got to have, I know there's a lot of Silicon Valley cyber firms that are trying to move out of Silicon Valley because of the expense, the cost of living. So I think there are real opportunities for us as a state to attract some of those places, some of the early startups or growth businesses, but you've got to have the trained workforce. You have to have the access to funding. And then it gets back to our educational system. Younger people don't necessarily want to move here because our educational system is not the best. And it just seems like we have to look at this as a state strategy of whatever, whether it's technology or cyber or, it was in the movie industry, to really have a strategy that all of the ecosystem is in place or pieces of it can be there for it really to grow.
It's a perennial discussion that we have. I mean, literally, we've got like technologies coming out of our labs. We have 2 of our prime examples here that have located in our state. How can we take advantage of the technologies coming out of there? So, Madam Treasurer.
If we're done with that conversation, I'd like to switch gears to page 213 and get educated on Sun Mountain. I think that's something to do with a golf brand. But it says that it's the largest exposure by manager across 7 funds. And I'm curious if you can give me some more information on that and the other 9 relationships that have the aggregate net IRR. I'm assuming that's internal rate of return of 10% or greater, and what is usually the game plan for that.
So Sun Mountain Capital is a investment manager in the New Mexico program. They manage a couple of different strategies for you. They're the general partner for the recovery fund. They're the general partner for most of the co-investment funds throughout the history of the program. And then they also manage, they're also the general partner of the Catalyst Fund, which is a fund of funds. And so the exposure across those three fund strategies is what makes up that large exposure that you see on that table. And then we actually aggregate the performance across all of those different strategies for that. And if you go to the next page, we actually break it down by the different strategies. So you can see, for example, like on the venture capital side, how they performed in the co-investments and Catalyst Fund, which are venture capital focused, versus the Recovery Fund, which is more private debt focused. So there's more details as you advance in this presentation.
Thank you, Madam Chair.
Great. Any further questions? All right, so now I believe we're going to take a break. That's something I have not encountered on our SIC agenda. We are running about 30 minutes behind. How will this break work, folks? Steve?
Madam Chair, we do not need to take a break. We just thought it would be helpful since we have a long agenda. It is your call.
I absolutely would appreciate a break, yep. So we'll reconvene at 10:45, 10:46, according to my computer clock. Okay, we're going to reconvene here after our 5-minute break. Much appreciated for adding that into this very long agenda. We're going to move now to our investment recommendations. We've got 4 private equity investments to vote on, 1 real estate investment, 1 policy vote, and 1 subscription vote. So it is quite long, folks. Going to remind everyone that brevity is desired at this point so that we can have time for council questions. And with that, I will turn it over to our illustrious chair of the investment committee, Member Lavender.
Thank you, Madam Chair. Although I did say something at the time, I just want to thank Lee for his involvement. It's been really neat having him on board. What I'm going to do is not take any more time at this point because we got lots of stuff going on, and instead just move right into the presentations. We had a good investment committee meeting. These were all approved unanimously, I believe, and we can obviously open for any comments or discussion. So moving right on to 3B.
Thank you. So this is a new relationship that we're recommending. It's a commitment to GenStar for $100 million in total, $80 million to GenStar Capital Partners 11, and $20 million to the Opportunities Fund attached to it, which is a co-invest vehicle that sits side by side with the fund. We're excited to start the relationship with GenStar. They've been one of the highest performing middle market buyout managers in the United States and have historically been access constrained. They'll be a great complement to other managers in our portfolio like New Mountain. In terms of in context of where it fits in the portfolio, they do, historically their largest sector has been financial services, followed by industrials and software. They also do healthcare investments in the fund, but it's a less focused sector. And this is a good split relative to what the buyout benchmark has generally, which is 26% IT, 17% healthcare, 18% industrials, and 7% financials. So this is a nice complement on the financial side to some of the other funds in our portfolio, including Bain Insurance, which we just brought last month. I'll pass it to Amy Ridge from Mercer to go into more detail.
Great, thank you. So today we're bringing you GenStar, the 2 GenStar funds for consideration, their flagship fund, which is an $80 million recommendation, and then their co-investment fund for a $20 million recommendation. GenStar is a long-standing firm. They were originally founded in 1988, and they've been executing a very similar strategy since that time. So that's one of the things we actually really like about this manager. They have 1 asset class, 1 office, and it really supports their one firm culture. And they're led by a really experienced senior team who averages 18 years at the firm. We also like they're focused on buying quality middle market companies in the 4 sectors that Chris just said. And essentially what they're looking to do is make good companies great, make those good companies into market leaders through a multitude of growth initiatives, which we also really like. Performance, which you will see on page 256 of your materials, has been strong. They have consistently produced over 30% net IRRs, and many of the funds have over 2 times net multiples. And on a peer comparison, when we look across the market, they have a lot of top quartile metrics. They're also very well aligned with their investors. They have a GP commitment that's expected to be 5 to 6%. That's well ahead of the market norm of 2%. And just a reminder, GP commitment is the amount that the GP is committing to the fund alongside all the investors. So again, we are recommending $80 million to the flagship fund and $20 million to the Opportunities Fund. And I'll now turn it over to Ryan Clark, who is president and managing partner at GenStar. And then I'm happy to take any questions you have.
Great. And thank you, Amy and Chris, for that introduction. And thank you for considering us here in your portfolio to New Mexico. It was a great intro, and actually you hit on all the high points, but just to introduce, and I'll be brief, Ryan Clark. I've been with the firm since 2004. made president in 2015, and really represent this third generation that's running Genstar. So as Amy mentioned, we've been around since 1988, 34 years. We've gone through two very seamless successions. And today we have 5 partners that are managing the business, and we are raising Fund 11. We're all based in San Francisco. The managing partner group has been working with each other since the early 2000s. So we did have the experience of going through the great financial crisis together and enduring that and other shocks such as COVID. We're very focused on verticals here. So I focus on financial services, on insurance specifically. We have a partner that focuses on software, a partner that focuses on industrials, and then a partner that focuses on healthcare. And we have 31 strategic advisory board members also to our team. And these are river guides. These are former CEOs who help us in our industries, who help serve on boards, help us do due diligence, help us find investment themes. And those are really critical to what we do. When I joined Genstar back in 2004, we were one of the early firms to have this operating partner model. And the insights that you get, the network they have of executives is really invaluable as we invest in our industries. Amy mentioned it well. We invest in high quality businesses in good industries. And we adopt a transformational approach. So we look at companies and say, what can we do differently with them? How can we turn them from good to great? How can we create a market leader from a number 5 or number 6 player? And that can involve leadership changes. In 2/3 of our companies, we changed the CEO and then the leadership team has changed. In almost all the companies, we're upgrading the team, whether it's a CFO or a chief revenue officer. We're driving M&A. One of the hallmarks we're known for is doing a significant amount of add-on acquisitions within our portfolio. I think we do over 100 add-on acquisitions a year. And then we have, for each specific investment, specific operational initiatives, margin improvements, go-to-market investments, new product introductions. But every investment that goes through our committee has to be a good quality business in a good industry, but that we can inflect to a higher growth curve. We have been a top 6 PE firm for the Dow Jones ranking this year. We are number 4. There was a data set aberration, but when they recalced it, we're actually number 4. And I think importantly, one of the comments I'll make is we've had a 0% loss ratio since Fund 6. So Fund 6, 7, 8, 9, and 10, we've had no losses. We do expect some losses in the portfolio, just given obviously we're in the leveraged buyout world, but we think that that's just a good indication of the business quality that we're investing in. And then, Amy mentioned this. People always ask, well, how are you successful? And I think one of it is just our focus. We've decided not to be a broad asset manager, not to raise a credit fund and a mezzanine fund and a small market fund, and instead just focus on this one vehicle. So one fund at a time. We don't have any third-party capital. All the economics are shared with the employees of the firm. Amy mentioned our GP commit, which tends to be 6%. Actually, if you look at the whole firm, including the SAB, we're about 8% of the fund. So about $850 million commitment to the last fund. And I'd expect something similar on this fund. So we have that focus of put all your eggs in one basket and watch them very closely. Sort of the Warren Buffett adage. And again, that's the only thing we do. I think that's contributed a lot to our success as we've seen other peers sort of dilute their efforts over time. The only other comment I'll make here is, it's an unusual environment in the sense that we're obviously in higher interest rates and sort of a slower market. Our portfolio, we have 35 companies that we're actively managing, and I think the good news is we're seeing really robust growth in 33 of them. So even with this economic uncertainty, we're looking at a portfolio that's very healthy and growing well. And so, as we say, our portfolio is hopefully durable under any circumstances or any times, and we're certainly seeing some interesting times now.
Is that it for the presentation? Great.
Yep.
Okay, we have a question from Madam Treasurer.
Hello. On page 250, just because this is not my wheelhouse, on the management fees, is that customary for this industry? Maybe that's a question for staff. I'm not sure.
Yeah, so the management fee for in the buyout space, we typically see 1.5 to 2%. So this falls generally in line with where we would see similar sized funds in the market in the buyout and is within that market range.
And Madam Chair, for carried interest and distribution waterfall, can you explain that to me on the 20% carried interest and the 8% preferred return?
Sure. So for the carried interest, so generally, they make investments and they have to hit a certain a hurdle rate or a certain return rate before, Ryan and his team get to take their carry or their portion of the profits. So here they have to hit 8% return to start taking their portion of that 20% of profits. It's a little different than co-investment vehicle. It's 15% is the starting of the carried interest, but essentially it's the metrics to make sure they're generating at least an 8% return before they are going to begin taking their portion of the profits. And this is also in line with the 20% is what we would expect. All those terms are in line with the percentages we would expect in the market as well.
Yeah, and that includes the management fee. We have to earn 8% on capital call plus the management fee. So that all gets repaid before we take carry.
Thank you, Madam Chair.
Lee, you can rest assured that we will continue to be asking questions about term sheets after your departure, sir.
Well, that'll be great. And, I'm trying to be nice today, but I didn't know if I should just vote no on everything day, just to do it. But
I mean, that would certainly, continue to fill your legacy. But if you want to go out on a high note, you might.
Well, the challenge, Stephanie, is that the staff and our advisors have been doing such an excellent job. I can't find a reason to vote against anything. So it's just been a great pleasure, but they're doing a good job and I plan on voting yes on everything, even though I'll miss that legacy.
All right. Any further questions on our GenStar investment recommendation?
Madam Chair, I think that, the way we've typically kind of done this is that I've done most of the motions simply because of the committee, but if someone else wants to jump in at a given point and you get tired of hearing my voice, that's one of the reasons I did my introduction so quickly. If you get tired of hearing my voice, someone else can jump in. I'll do this one and we'll go from there. Based on the recommendations of the Council Investment Committee and Consultant Mercer, SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $80 million to one GenStar Capital Partners 11 LP and up to $20 million to GenStar 11 Opportunities Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiations of final terms and conditions, and completion of appropriate paperwork.
Madam Chair, I'll second the motion. I was waiting
we've got
for
a proper motion and a second. Yeah, the motion, the second is easier than the motion on these ones. So we've got a proper motion by Member Lavender, a second by Madam Treasurer. Any discussion on the motion to approve a $100 million investment to GenStar? Okay, hearing no discussion, we'll have Andy take a roll call on, sorry, where are we? Agenda item 3B.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
I think this is maybe the last meeting I'll get to vote after Mr. Rawson, and thank you for all your service again. I vote yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Thank you, and thanks to the folks from GenStar for being on with us today.
Great. Thank you. Thanks for your time and commitment.
Great. All right, next agenda item 3C, another private equity recommendation into Menlo Ventures 16. Turn it over to Chris.
Thank you. So this is a re-up. It's a recommendation to commit $30 million to Menlo 16, which is the firm's flagship early stage fund. Menlo is a long-standing venture capital firm in the Silicon Valley area. When we started in 2020, or stepping back, historically, we had not focused on venture capital in the national program. In 2020, we changed that, and Menlo was our first commitment to venture in that program for many years. They're a really solid seed and Series A manager. They have an enterprise focus with some consumer, financial technology, fintech, and digital health. That exposure is generally in line with what's in the VC benchmark. The firm has done a really good job with hiring and keeping the team fresh and with new talent, which I really like, and that's really paid dividends in Menlo 15, which is our first fund with them. I think this is we get to spend a lot of time on the detail. I think their 2020 vintage fund, which is our first fund with them, will prove to be a good fund on a relative basis. They've stuck to their knitting. They've not kind of gone, I think that there was some kind of speculative behavior in the venture ecosystem, I think is an understatement. And Menlo stuck to their knitting, did their core activities, kept valuations at a reasonable level. And so we're excited to continue the relationship with them. In addition to the early stage fund, we're also investors in their Inflection platform, which is their early growth platform. And that fund as well, which we committed to a year or two ago, they've been very disciplined as well. And a lot of that capital has yet to be invested as they wait for a better market opportunity. I'll pass it along to Richard to discuss the investment in more detail.
Thanks, Chris. And yeah, just a reminder to the council, the SIC previously committed $30 million to Menlo Ventures 15 in 2020 and $45 million to the third Inflection Fund in 2021. And the Inflection Fund focuses on funding later stage companies within venture capital, whereas this fund that we're talking about today is more focused on early stage. Menlo Ventures is one of the oldest venture capital firms out there, but they have undergone a leadership transition, and they're led by three senior investment partners, Matt Murphy, Sean Carolyn, and Venki Ganesan, who have really led over multiple funds at this point. Some of the differentiators for Menlo that I think are worth pointing out: the firm has a sizable team, including 19 investment professionals and a large team of partners as well to support the three senior investment partners. But one of the unique things about Menlo is they have built out a pretty sizable team of 5 people to really focus on operational improvements, which they call their fuel team, which is really tasked to grow and scale portfolio companies across various initiatives like talent, marketing, business development, and network development functions. I think sourcing is also a key differentiator for the firm. I mean, the partners and Menlo Ventures name has been around for a long time, so they have a deep network in the entrepreneurial community. And when they have successful outcomes, that also feeds into their sourcing engine as well, because those entrepreneurs may start new companies or they may refer others to Menlo as well. Menlo's really invested in a lot of companies that have emerged to be some of the most successful venture-backed companies. Names like Uber, Roku, DocuSign, Dropcam, and Siri. The performance as of June 30th ranges from 14% to 40% on a net of fee basis for the recent funds overseen by the current management team. And the performance in the more mature funds are generally above median against the benchmarks. But I think one of the interesting characteristics of performance is the distributions, which have been above median across their 2011, 15, and 17 fund, which is good to see when venture capital can have longer hold periods. So we're recommending a $30 million commitment to Menlo Ventures 16 as a re-up. I'd like to introduce Venki Ganesan, who's one of the managing partners from Menlo Ventures, who's been with the firm for over 9 years. And after his short presentation, we're happy to answer any questions.
Thank you so much for the introduction, Richard and Chris. Thank you so much for all the effort, and very excited to be here. Venki Ganesan, I'm one of the partners at Menlo Ventures. Madam Chair and council members, it's a real privilege to have the opportunity to present in front of you. As Richard and Chris mentioned, Menlo is a 46-year-old firm. We have a long established track record of success across both good times and bad times. Personally, this is the fourth sort of downturn I've been part of. And what I'll tell you is that our winning formula has been the same. We are super disciplined. And as the staff will show you, even in the last few years when perhaps some of our peers were not as disciplined, we've been very disciplined in our entry valuations and in making sure that we prepare the company. One of the things I'm most proud of is that as we go into this downturn, we made sure that our portfolio companies are well prepared. 88% of our portfolio has, 18 to 36 months of cash. We made sure that our portfolio companies are prepared for this downturn. We also made sure that we could get liquidity when the markets were well. Over the last 5 years, we returned over $4 billion. Just to put this in context, over the last 46 years, we've returned $8.5 billion back to our LPs, but half of that happened over the last 4 years. And that's been a very conscious strategy to make sure that we can get liquidity where we can. We are focused on building very transformative companies. As Richard walked you through, we've been lucky to have been involved with companies like Uber, Siri, Gilead, which we incubated. And now we are focused on, I think, two really exciting areas. I'm sure you've heard of something called generative AI and ChatGPT. I'm proud to say that one of the fundamental building blocks for ChatGPT is a company called Pinecone, which is a Menlo 15 company, which you are exposed to. And what it does is that if you have ever played around with that technology, it's very transformative, but today it's not very accurate. Pinecone helps OpenAI and ChatGPT get more accurate, and you already investors in it. Other area of focus for the firm is cybersecurity. And I know that there are various members on the council who have experience there. Cybersecurity has been a big area of focus for the firm. For me personally, I lead the cybersecurity practice. We were investors I was on the board of a company called Palo Alto Networks for 10 years, invested in the company when they had less than $200K in revenue. They probably do close to $3 billion today. Menlo was the largest investor in Ironport, which became Cisco Security, largest investor in Q1 Labs, which became IBM Security. And that's a big area we are focused on right now. I know we are very short on time and we have a long agenda. So I will yield my time back and take any questions you have. But I do want to thank both the Chris and the Mercer Group for all the work they've done. And I want to tell you that, we don't take lightly being a steward of public sector pension funds. Our anchor tenant in Menlo is Washington State Investment Board, which has been the anchor tenant since 1981, so since Menlo 2, and they remain the anchor tenant in these funds. We know it's a privilege to manage public capital, and we know we have to earn that trust every fund, and as I say, every day, every year, and that's our plan, and we are grateful to have that opportunity. Thank you very much.
Thank you, Mr. Ganesan, and especially for the word, your words around the importance of the work that we do in investing public funds here in New Mexico. I appreciate that you understand the unique nature of those investments. All right, we're going to council questions now on the Menlo Ventures investment recommendation.
Madam Chair.
Madam Treasurer.
I apologize. I'm listening to you on my phone and doing the visual elsewhere so I could hear you better. I apologize for that loud noise. My question again is on page 308 on the management fees fund term summary. I see that it is different from the previous, and I'm not very familiar with the organizational and fund expenses and how that works. So if someone can just give me a quick briefing on that.
Yeah, I'd be happy to. So venture capital does have more aggressive terms than buyouts. So you'll see management fee higher, typically in the range of 2 to 2.5%. So Menlo Ventures is right within that range. Carried interest, the distribution waterfall. Typically, there's no preferred return with venture capital. It's really rare for a venture capital fund to have a preferred return. And a lot of the better funds will have a scaling carried interest where it goes from 20% to something greater depending on the return of the fund. So as the fund gets a larger return, the carried interest actually gets larger as well. On organizational expenses, what that refers to is the expenses that it takes to really organize and start the fund. Everything from the legal expenses, the registration expenses, investor relations and fundraising expenses, those are all included. And we like to see a cap on those just so that there is some type of budgeting that the general partner has to do so that the fund doesn't take on all of the expenses if they go above that limit. And so you'll see in Menlo Ventures, there's actually a limit of up to $700,000 that they'll pay.
And as far as the general partner capital commitment section, the commitment expected to be funded 50% in cash, 50% in management fee waivers. Can you explain that one to me?
Yeah, sure. There's two different ways that we see that. First of all, the general partner commitment is the amount of capital that the management team is committing to the fund alongside limited partners. And so we like to see that number as large as possible because we want to see the management team really invest alongside partners. In reality, it's around 2% on average. There's two ways that the management team can commit. One is through making a cash contribution and writing a check whenever there's a new commitment, a new investment made. The other way is through a management fee waiver, which is basically diverting management fees over to pay for the general partner commitment. There's some tax reasons why they do that. From an alignment perspective, though, we always like seeing cash contributions over the management fee waiver. But a lot of funds in the U.S. will actually use management fee waivers because there is tax advantages to doing it that way.
And Madam Chair, last question, is it standard for us to permit going from 15 to 20% to 50%, 25% with LPAC approval? I'm not sure what LPAC is. That's on the portfolio limitation, same page.
So the portfolio limitations, yeah, so those are kind of the guideposts that are in the limited partnership agreement to ensure that, when you give your money to a manager, they're not just going to go out and put it all in one company. There's limits to what they can do within the fund. And those are the ones that have been formalized in the limited partnership agreement. Limitations such as how much they can put towards any single company. The LPAC is the Limited Partner Advisory Committee, which is usually a group of the largest limited partners in the portfolio. And so in some cases, Menlo Ventures can go back to the LPAC and get approval if they think they're going to go over a percentage and have the LPAC review and approve that.
Madam Chair, I think I understand I understand what it's trying to do, but is it standard for us to go from 15 to 20 to 25% of the portfolio? Is that customary, or is that something we're comfortable with? It's a huge difference.
As a practical matter, this fund will be significantly more diversified than that. If you look at page 291, gives you some broad strokes as to what they expect in terms of total number of positions, and then what potentially the largest positions will be. I won't say it out loud in a public forum, but gives you a general idea of what they actually expect the largest positions within the fund to be, which is significantly lower than the percentages that are put in the limited partnership agreement.
And the limitations are consistent with what we see with other funds in the market.
Thank you, Madam Chair. Appreciate it.
Further questions? Are we ready for a motion? Member Lavender.
Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $30 million to Menlo Ventures 16 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
Okay, we've got a proper motion by member Lavender, a second by member Tejas. Any discussion on the motion? All right, and just for folks following along at home, the State Investment Council is considering a $30 million investment into Menlo Ventures 16, agenda item 3C. We could have Andy take a roll call vote on that motion.
Commissioner Garcia Richard,
Yes.
Treasurer Montoya,
Yes.
Mr. Lavender,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Great. And we thank Mr. Ganesan for being on with us and for all of the good work of staff and Mercer on the due diligence. Thank you.
Thank you very much for your support. Just if I could add one more thing, I was chairman of the National Venture Capital Association and spent a year thinking about how we can get venture capital to other parts of the country. So, Madam Chair or Commissioner or Council Member Allen, if you want to talk about what some of the things NVCA is doing to help bring venture capital and entrepreneurship to places like New Mexico, I'm happy to do that. Thank you again. Grateful for your trust.
Thank you. I think the answer would be yes. We do want to talk with you about that.
Yes.
Thank you.
All right, great. Okay, so we're moving on to agenda item 3D. Goodwater Capital 5 and Goodwater Infinity 3. Again, turning it over to Mr. Cassidy.
So this is another new relationship. We're recommending 25 million of total commitments to a firm called Goodwater and their funds. We're recommending a 20 million commitment to Goodwater Capital 5, which is the firm's early stage fund, and 5 million to Goodwater Infinity 3, which is the firm's growth fund. Goodwater is a consumer tech manager with a global focus. And specifically what that means is they look to invest in what they call core consumer digital utilities across housing, healthcare, food, financial services, transportation, education, and entertainment. Roughly 80 to 90% of what, in terms of geographies of what they invest in is US, South Korea, and Europe, but they also invest 10-20% in more unproven geographies in Asia, excluding China and Latin America. Places such as Indonesia and Mexico. Goodwater provides a very unique exposure as we build out our venture capital portfolio. To give you some context, consumer discretionary is roughly 12% of the benchmark, and financial technology is roughly 6%. And investments outside of the US is roughly 30% of the benchmark, amazingly. And interestingly, it's relative to what we see in buyout, which is more US and Europe focused, 21% of venture capital of that 36% is actually Asia. Goodwater was set up by experienced investors based on their experiences at prior firms. They thought that a focus on consumer tech would better serve investors and founders, one. They felt that consumer tech is a global opportunity, number two. And number three, they felt data and software will increasingly disrupt the traditional VC model. I got to know the firm over the last year. I saw how their data science approach has really helped them steer clear of some overhyped areas where consumer adoption was not proving out the hype related to certain sectors. And two, they've also been able to unearth some very interesting opportunities outside of the US that frankly would be additive to our venture portfolio. I think they've developed one of the more interesting financial technology portfolios. Some of the most interesting companies are actually based outside of the United States. I'll pass it along to Richard for more details.
Thanks, Chris. As Chris mentioned, this is a new relationship in the national program, and it is focused on consumer technology, which is somewhat unique within venture capital. A lot of venture capital firms have a strong focus on business to business or enterprise companies now. So it is a exposure that we're excited to get in the national program. Goodwater was founded in 2014, and the founders, Chi-Hua Chin and Eric Kim, are also the firm's managing partners, and they both had previous experience at well-known investment firms before founding Goodwater. And what makes this firm unique is they've really set up a strong data analytics and research platform for sourcing new investments. They utilize machine learning and pattern recognition and data from millions of companies collected monthly. And these models seek to identify compelling companies before they need financing, and then Goodwater can begin its investment process to evaluate a company and establish a relationship before a company even needs capital. And this data platform is not just used for sourcing, but it also is used to help portfolio companies. It can really help companies by offering benchmarking against similar companies at a similar stage of development and review market and industry trends. And there isn't really a lot of good data out in the venture capital industry. So this is a unique offering that Goodwater can offer to its portfolio companies. From a performance standpoint, Goodwater's generated favorable performance in the past. There's several data points that give us comfort from the track record, including generating multiple 10 times or greater investments. The firms also had success across different subsectors within consumer technology and also different geographies. The terms are aggressive for venture capital, as we talked about with Menlo, and it's not uncommon to see with funds that have generated strong performance like Goodwater. You know, we balance all of these factors together when considering a fund and feel this is a good addition to the portfolio with both the exposure and the platform that Goodwater provides. So we're recommending a $20 million commitment to Goodwater Capital Fund 5 and a $5 million commitment to Goodwater Infinity 3. And I'd like to introduce Chi-Hua Chin, who is one of the co-founders and managing partners of Goodwater, to give a short presentation, and then we're happy to answer any questions following his presentation.
Thank you so much, Chris and Richard. Madam Chair, council members, it's a real privilege to be here today. I really enjoyed the conversation before the break regarding entrepreneurship education and its importance. I am the product of a great entrepreneurship education. During undergrad, I went to engineering school at Stanford, got involved in the mid-90s in a program there called the Stanford Technology Ventures Program. I have actually been a teacher in that program for the last decade and have seen the benefit of systematic entrepreneurship education there. I teach a class there called Intro to High Technology Entrepreneurship and Venture Capital. It's produced many of the great entrepreneurial successes, both in terms of entrepreneurs and managers of companies here in Silicon Valley over the last decade. So if I can ever be of any assistance, you can actually find our curriculum online. It's Stanford's published curriculum that's used in 20 countries around the world. And I would love to be helpful on that front. This is my 21st year as a venture capital investor. I got my start in the business in 2002. In an interesting time at the conclusion of the first internet bubble. We were really in a cleanup period of time. I joined a firm in Palo Alto called Excel Partners. Initially started as an associate there, helping to turn around broken companies, and a time not too different than right now when capital efficiency was really critical to get companies working. In 2004, I started moving to the investment side, and in the basement of Stanford Business School, I came across a little 6-person startup with 270,000 registered users called The Facebook. And we found that company. We worked on the Series A investment opportunity, remarkable characteristics, 65% daily active users. Within 4 weeks of entering any college campus, 80% of the students had signed up. We led a Series A investment of $11.5 million into that company to own 13% of it. Eventually, as you guys know, has gone to be quite a significant business and a spectacular venture return. And I was hooked. That was the start of my career. So I spent 5 years at Excel Partners as an associate. In 2007, I was recruited by a firm on Sand Hill Road called Kleiner Perkins to help reboot their consumer technology practice as a young partner there. They had actually spent a lot of time. They were investors in Amazon and Google and Excite and Intuit, many of the earliest internet foundational companies, but had pivoted actually to focus primarily on green tech. So I joined in 2007 to help reboot that consumer tech investing practice. And over the course of 7 years there, led or co-led investments in Chegg, which is now the largest ed tech in North America, Square, Path, Clout, Twitter before it had any revenue, Spotify when it was still just a small subscription business in Northern Europe. And in 2014, decided to leave Kleiner Perkins and join forces with my good friend and business school classmate, Eric Kim, to found Goodwater. We founded Goodwater on a really, really simple thesis, which is that consumer technology is the most powerful force on earth. It's transforming global culture and changing the global economy, altering the global economy at really unprecedented speed and scale. But there's no venture capital firms that focus on it. And as Chris had articulated in the introduction, it's really just serving the core utilities that are required for human flourishing: housing, healthcare, food, financial services, transportation, education, and entertainment. If you go anywhere in the world and you ask any one of the 6 billion internet connected consumers, would you like to have better access to lower cost, higher quality housing, healthcare, food, financial services, transportation, education, or entertainment? Not a single person would say no to that. And that's what our companies do. Our firm was founded on the belief that consumer technology is this incredibly powerful change agent for improving the lives of humans around the world. And through technology leverage, we can deliver better access, higher quality, lower cost versions of those 7 digital core utilities for human flourishing. The firm was really founded on 3 core pillars. The first is 100% focus on consumer tech. That's all we do. That's all we're ever going to do. We believe that depth of focus and consistently applying ourselves to solving these problems is critical for generating investment returns. Second, the data platform. As Chris and Richard had mentioned, we've invested heavily to build a data and software engine that enables us to monitor 10 million companies globally in real time and understand how they're performing. So we can rifle shot in and pick off the best companies in the world in each of those 7 categories. And finally, mission and values. Our mission is really the foundation of what we're doing, which is to empower exceptional entrepreneurs everywhere to change the world for good. And that's expressed through a set of 6 core values that we believe can really shape these companies and downstream the customers that they serve. And those core values are integrity, transparency, quality, service, humility, and justice. So fast forward 9 years since founding the firm, we're now 66 people. We have 73 core portfolio companies in 18 countries around the world. We have 600 seed stage companies in 51 countries around the world, and we manage steward over $3 billion of investment capital. I just want to touch on, as a last comment, our core differentiation, because what does it mean to use data and software at the core of an investment firm? It means that at every single step of the investment process, we can generate investment alpha by sourcing better opportunities, by better managing our pipeline, by leveraging software to pick companies more effectively and pressure test their performance against our data set, by winning deals, and then finally in portfolio management, by better serving our portfolio companies. So let me give you a few key examples of what it means to use software. Our data platform tracks 10 million companies in real time around the world, so we can actually see how quickly these companies are growing. That data platform also uses several hundred machine learning models sitting on top of it, which basically function as super smart associates that spot companies that are inflecting and growing, and so that we can dedicate our human capital, our investor time, to those companies. What it also enables us to do is provide service to a portfolio of 600 seed stage companies around the world who are sending us their data that we can then use to make good Series A, Series B investments. We also run a master classes program that is software enabled that brings on some of the great operating leaders of the world, the president of Tesla, the CEO of Amazon Consumer, the COO of Activision Blizzard, the head of product at Tinder, to come and teach these hundreds of companies how to actually operate themselves more effectively, which gives us a lot of alpha generation on the portfolio front. So in conclusion, we think that this is a great environment for investing now. Valuations are reasonable. Again, as I look back across 21 years of doing this, this looks more like the 04 to 06 vintage or the 08 to 2010 vintages, where prices are reasonable. Again, companies are very, very capital efficient. And we have a systematic process for sourcing the best and fastest growing consumer tech companies around the world. It's really an honor and a privilege to invest on behalf of the New Mexico State Investment Council, and we are committed to stewarding your capital well in this environment. Thank you very much.
Thank you, Mr. Chen, for being on with us, and thanks to staff for the background. Because this is a new firm to the SIC, there may be a number of just kind of fundamental questions about operations in addition to the investment questions, but we will open it up at this time to questions from council. All right, we got member Allen.
All right. First of all, I'm going to follow up with you to maybe come back out to New Mexico and help us in thinking about economic development and getting more venture and entrepreneurial thinking here. I appreciate what you're doing. So just sort of an interesting question, since your name is Goodwater, are you investing in any water technologies? Because that's one of the challenges we all are having. And is that a consumer interest area that you invest in?
Thanks for the question. Despite the name, we are not investing in water technologies. We're investing in digital consumer utilities. So in this particular case, there isn't a water resources emphasis for the firm.
And you are investing in fintechs?
Yes.
Is that the total of your questions, Member Allen?
Yes.
Oh, I'm sorry. Okay. We have Madam Treasurer.
Well, hello, and thank you very much for the presentation. You do sound like a teacher for sure. So I have, on your presentation itself, there was quite a few things that very clean and I just want to make sure I'm clear on something. So all of yours is technology, but for example, on page 378, the idea of what you invest in within technology helps other areas such as financial services, healthcare, education, transportation, real estate, and on and on. Is that correct?
I don't have the
So she's referring to the slide where it says massive industries coming online and talks about the 7 sectors in which that are your focus. Maybe if you could give some examples of the types of companies and some of the categories like financial services or healthcare, to give the folks a sense of what it is you're investing in.
Sure. So that slide is a really good illustration because on the left-hand side, you see the $700 billion of global advertising spend. That industry coming online is what gave rise to Facebook, Google, Twitter, about $3 trillion of net new market cap was created by traditional advertising coming online into online mobile and web platforms. We believe that this next generation of companies, entertainment, real estate, transportation, education, healthcare, financial services is more than 20 times larger than the advertising market, the global advertising market. All of these industries are traditional industries that are very, very inefficient. They're burdened with high cost structures, no software operating leverage, and in many cases provide really poor end user experiences. The satisfaction, CSAT scores in most of these industries is really, really low. So if you think about Goodwater systematically at a portfolio level, what we're doing is we're finding the entrepreneurs who are building better products for end consumers. We don't do enterprise software, for end consumers that provide them with better versions of each of these things. So a couple concrete examples. Chris had referenced a company that we found overseas in Korea that does peer-to-peer payments. So it started as a peer-to-peer payments platform that had a very simple observation. To transfer money in Korea between two people, two banks, took 35 clicks, and you had to enter your password 3 times. And if a transaction was over $20 US, you had to actually pick up the phone and verify it. They turned that into a 3-click experience on mobile. The company now has 16 million active users, over $1 billion in revenue, growing 60% year on year, as they took that very simple consumer pain point and then they solved it elegantly and surrounded it with a whole bunch of other high quality consumer financial services that are necessary for somebody to just live their daily life. So those are the types of products and services that we will identify and then support from a very early stage. I was a pre-revenue company when we invested in it, support it all the way through to its eventual scale.
Okay, and Madam Chair, 13 unicorns in 8 years, what does that mean?
13 unicorns in 8 years. Unicorns is a definition in the venture capital ecosystem of a company that has achieved a $1 billion valuation. And so it is a demonstration of our ability to find these companies systematically around the world across sectors and do it pretty consistently.
Thank you. Madam Chair, I noticed on the presentation, the mission is to empower exceptional entrepreneurs everywhere to change the world for good. But I had a question on a page that discussed, let me find it, page 366. I didn't quite understand. It says ESG assessment. Goodwater currently does not have a formal ESG policy. However, the firm is considering developing a formal policy to codifying the existing process and principles employed in the investment process and among firm and employment interactions. I wanted to know, how does that connect to what you're doing in technology, or why was this the assessment that you have when your mission, it sort of contradicts your mission and your goals?
So Shiwa, this reflects that you currently don't have a more formal ESG policy at this point, but maybe you could talk about your general firm mission, even though you don't have a specific ESG policy at this point.
And if you could add on to that answer, if you are intending, I mean, it seems this is a due diligence statement from Mercer. It seems to indicate that you are maybe in the process of developing something along the lines of an ESG policy. Could you address like the timeline for that as well?
Yeah, it's a great question. Thank you, Madam Chair. We have not formalized an ESG policy yet. We're in the process of analyzing that. The way that we think about guiding our investment strategy is really according to those 6 core values, which are really foundational to the firm: integrity, transparency, justice, service, humility, and quality. And what does that mean? That means that when we look at a particular investment opportunity, for example, in the consumer credit sector, we ask ourselves the question, is this just? Is the company pricing its products in a way that is just and fair to the consumer and able to help improve their lives? Or does it cause them to get worse and worse into debt? Because there are many very extractive credit products that are out there. The same methodology or thinking is applied across healthcare. There are many examples in healthcare where we have to apply that lens, entertainment products as well, education products as well. The way that this all comes together when we think about tactically what this means for the firm is we have a program called The Collective. And The Collective is where we actually take profits that we have generated in the firm and we provide those back to our portfolio companies in the form of grant financing, non-dilutive grant financing. So a couple examples of where that has been applied. We have funded companies in our portfolio, for example, in financial services, to provide a combination of financial services education and an initial investment account of between $100 and $1,000 to help people learn how to dollar cost average into public equities. Roughly 100 million Americans earn enough that they should be allocating a portion of their weekly or monthly earnings into the public markets in a safe, distributed, low cost dollar cost average portfolio, but most people don't because it's intimidating and it's hard. So that's an example of the collective where we've actually given a company grant funding to go do that. Another example is a lot of college students right now are struggling with mental health problems. And so we've provided grant funding to one of our companies, Uper, to actually provide mental health services for free to college students who signed up for that. So that's really the way that we operationalize our values in the context of the investment business that we run.
Could I just interject here? What is a timeline for formalizing that into a policy, though?
You know, we're working on that, and I don't have a firm timeline, Madam Chair, to share with you, but I think it's something that we would have clarity on in time for our next fund.
And if we could, is there any way to have access to what you are considering? So kind of along the lines of what you just shared with us. What aspects are you considering as part of a formal policy? Is there a way to get access to that, or is it already in our presentation materials?
We can certainly follow up with you guys.
Okay, I believe, Madam Treasurer, did you have more on that? Okay.
Thank you.
Any further questions from council on the good water recommendation?
Actually, Madam Chair, just for the committee, it also mentions Goodwater is willing to review side letter requests allowing limited partners to opt out of objectionable investments such as businesses involved in tobacco, weapons, alcohol, and/or fossil fuels.
Yes, that is listed there as part of the ESG assessment. Thank you, Madam Treasurer. Is there a motion? Yes.
If you're ready, Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RVK, I move the State Investment Council approve a commitment of up to $20 million to Goodwater Capital 5 LP and up to $5 million to Goodwater Infinity 3 LP, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Do we have a second?
Second.
All right, we've got a proper motion by Member Lavender, a second by Member Rawson. Is there any discussion on the motion?
Madam Chair, is it appropriate to add in just a side note that whenever they do get information regarding those items, if they can give it to our team?
Yes, so we are formally making that request of you all, Mr. Chen, to provide us with whatever terms you're considering around developing a formal policy. I don't know that we need to necessarily add it to this motion, though. Okay. All right, so just for folks who are listening on at home, this is a total of a $25 million commitment to Goodwater, $20 million to Goodwater Capital 5, and additional $5 million to Goodwater Infinity 3. And we're going to have Andy take a roll call vote on that motion.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Great, and we thank Mr. Chen for being on with us from Goodwater.
Thank
We're
you
not
very
picking
much.
on you, sir. We actually are very much undergoing a deep dive into ESG policies, across the board, as well as developing our own just recently. So we appreciate your sharing detail on that and your patience.
Absolutely. Thank you so much. It's a real privilege to invest on your behalf.
Great.
Madam Chair.
Member Rawson.
Yes, I've got another commitment, so I'm just going to have to run right now, but it's been a privilege to serve with each of you and wish you the best. And I'm sorry I have to leave early today.
Well, I'm glad that everyone got a chance to give you their well wishes at the top of the meeting, Member Rawson. We'll miss you.
Good luck, Lee.
Good luck.
All right, great. Okay, let's move on. Agenda item 3E. And it's our final private equity vote of the agenda for TA 15-A. And we're going to turn it back over to Chris.
So this is a cleanup item from our last meeting. The last meeting, the SIC approved commitments of up to 225 million to TA 15 and up to 75 million to TA Select Opportunities Fund 3. Rather than raising two separate funds, TA's decided to pursue a single fund strategy and focus on TA 15 at this time. Therefore, we're asking, or we're now recommending that we revise the commitment up to 300 million to TA 15, just one commitment rather than two. I did not know that what GenStar mentioned about their ranking within the Dow Jones ranking that comes out annually. I was wondering why they weren't high on the list. TA was ranked number one in that list. So glad to see that we're adding managers or keeping managers that are ranked highly in that list. One of the other managers we had in October, Waterland, was the number one firm in Europe in that list. But in any case, if you have any questions on this one, please let me know.
So just this will like negate the other vote, or like how does this?
Yeah, we'll replace it. Yeah.
Replace it?
Madam Chair, the investment committee felt it was a good idea to come before the council just because the terms have changed. We've all, we vetted this at the two particular meetings and then the last investment SIC meeting. And this is simply changing from 225 and 75 to 301 place. And the investment committee recommends this. And if there aren't any questions, I can put this motion out pretty quickly.
All right, so there's the dollar amount is the same. It's just not going to be in two vehicles. It's only going to be in one.
Yeah,
that's
correct. The way we wrote the motion, it was two separate, up to 225 and up to 75. So we had to amend it to be up to 300 for the one.
Let's just make sure there are no clarifying questions from members.
Madam Chair, I have one for clarification. I think when we do that, we also have to put within the motion to strike that previous request, because if not, then it's 300 from that one and 300 from this one.
So Evan, can you speak to that? Are you there, Evan?
I'm there. Can you hear me?
I can.
Okay, I think the motion drafted is fine. I think it supersedes, it's in the notice, it's gone to the public, it's been the requisite number of days. And I think as a housekeeping matter, what we need is to be able to put 300 million in TA 15. TA Select Ops 3 isn't going to exist, so effectively the vote to allocate 75 to that vehicle is moot. So if you would prefer to add a strike sentence, I think we've covered it in the minutes. I don't think it's necessary for the motion, but the minutes can reflect that comment, and also my answer that you're legally covered. This is appropriate under all rules and regulations, and you're good to go to read the motion to make this happen.
How does that sound to you, Madam Treasurer, if it's reflected in the minutes?
I'm fine with that.
Okay. Member Lavender.
Based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $300 million to TA 15-ALP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completions of appropriate paperwork.
I'll second the motion.
Okay, we've got a proper motion by Member Lavender, second by Madam Treasurer. Any discussion on the motion before us?
Question is to note on the minutes that this replaces the previous agenda item that we had at our last meeting for the 300 million split.
All right, with that, we will have Andy take a roll call vote on correcting our investment to 300 million to TA 15-A.
Commissioner Garcia Richard,
Yes.
Treasurer Montoya,
Yes.
Mr. Lavender,
Yes.
Mr. Messina,
Yes.
Mr. Tejas. I'm sorry, I couldn't hear you, Mr. Tejas.
Yes, I vote yes.
Thank you. Ms. Allen,
Yes.
Mr. Bingman,
Yes.
Madam Chair, the motion carries 7-0.
Great, and thank you so much for that work. Okay. With that, we're going to move to our last investment vote of our agenda, and it's a real estate investment into AEW Partners Real Estate Fund 10. Turn it over to Mr. Sable first, and then you can call on folks that have joined us from Townsend and from the manager.
Great. Thank you, Madam Chair. So joining me in addition to Townsend will be Candida Hobricks and Anthony Crooks from the GP. We are recommending a $100 million re-up into AEW's Real Estate Partners Fund number 10. Current market environment is characterized by rising rates, creating revaluations of real estate more broadly, and that in turn causing some dislocations in the market. We believe that AEW is well positioned to take advantage of such opportunities. They're a large manager with over 90 billion in AUM globally, 40 billion in the US. Lion's share of that AUM is in core and value added strategies that are coupled with a best of breed research platform. We believe that being able to understand the core and value add markets gives the GP an edge in terms of underwriting opportunistic exits. Finally, we believe that the strong historical track record in this strategy will validate the thesis. With that, I'll hand off to Seth.
Thanks, Keith. And I'll talk briefly here before handing it to the AEW team. So this is a $100 million commitment. This is a follow-on to a $75 million commitment we made to Fund 9 in 2021. In 21, AEW was a new manager to the SIC, but as Keith mentioned, they've been long and established track record within the private equity real estate environment. Fund 10 is targeting a $2 billion closed-end commingled opportunistic fund, targeting mid-teens net returns. We're seeking to participate here in the first close, which would result in a discount to management fees due to that timing, as well as being an existing investor with AEW. From a portfolio construction standpoint, this investment would sit in our non-core opportunistic portfolio. From an investment pacing perspective, we're still finalizing the models, but the pacing here is anticipated for 2023 to be in excess of $700 million. And this would represent our second commitment this year, totaling about $200 million. As I mentioned, AEW is a blind pool fund exclusively focused on North American real estate, as well as the ability to invest tactically based on how the market environment plays out. Specifically, AEW will seek to opportunistically acquire assets at a discount to replacement value and or recapitalization of broken capital structures. Within that opportunity set, the fund primarily tends to capitalize on really demographic trends that we've been discussing at prior meetings. Specifically, these are multifamily, industrial, medical office, healthcare, real estate. Also, the fund and the team has experience recapitalizing and utilizing rescue capital and bank loan situations that may drive opportunities to acquire assets at an unusual deep discount, given the current market environment for things like office, hotel, and retail. We compared several opportunistic fund strategies and selected AEW really due to the well-respected global real estate investment team, strong fund series performance with that stable team, the attractive fee structure that's outlined in your materials, and the relatively small size, which plays well from a portfolio construction standpoint compared to some of our larger fund commitments in the private equity space. So this portfolio or this investment is buy rated by Townsend and has been approved both on a standalone basis as well as for the SIC. I'll stop here and hand it over to the AEW team for their prepared remarks.
Thank you, Keith and Seth, for that introduction and all of your work underwriting the Partners Fund series. Good morning, Madam Chair and members of the Investment Council. Thank you very much for having us here today. I am Candida Hubris with the AEW Investors Relations team, and I am joined by my colleague, Tony Crooks, Senior Portfolio for the AEW Partners Fund series. Before presenting AEW Partners Real Estate Fund 10, I will give you a brief update on the AEW platform and then turn it over to Tony to discuss the fund strategy. But first, we want to say thank you very much for your continued support and partnership in AEW Real Estate Partners Fund 9. I believe the partners overview slide begins on page 432 of your books. So with that, with over 40 years of investment experience exclusively focused on real estate, AEW continues to grow and remain one of the largest real estate investment managers globally, with 89 billion of assets under management and 850 employees in North America, Europe, and Asia. In North America, we have a team of 330 employees actively managing 46 billion of assets across a broad spectrum of property types and geographic regions, giving our investment teams a wide perspective. As you may recall, and as Keith mentioned, one of the cornerstones of our platform is our research team, comprised of highly experienced urban economists providing a macroeconomic perspective, as well as a top-down assessment of market fundamentals and industry drivers. The AEW Partners Fund series is our longest running strategy with a 30-year track record of creating value, harvesting gains across a broad array of property types and structures throughout various economic and market cycles in order to deliver successful performance to our partners. So with that, I'm going to turn it over to Tony, who has been with the Partner Series for 23 years. And afterwards, we're happy to answer any questions you may have. Tony, you're on mute. Sorry. Sorry about this. I'm not sure. We're having technical difficulties on our end here.
Try checking your volume. Sorry, try checking your volume on your actual computer screen. That happened to me at the beginning of the meeting. Nope.
Yes. Wait, no.
A little bit.
Okay, sounds good. Thank you, sir.
All right, give us a minute or two while we sort through this.
Are there questions just on the due diligence until we hear from Mr. Crooks? Okay.
Madam Chair, I'm actually ready to make a motion if it's appropriate.
Nope. Sorry, sir. I appreciate you being on, even though we can't hear from you.
So sorry about this. I'm not sure what's happening on.
Can you use the call-in number?
Yeah, Tony, why don't you call in? My sincere apologies.
The number is 1-669-444-9171. Meeting ID number 847-8838-3924. nod your head when you're ready for the passcode.
I think he might be in. Are you in?
Passcode 576526.
Well,
How's that work? Does that work better?
if you'll
Yes,
mute,
yes,
yeah.
Tony.
Okay, I'm really sorry about this. Really sorry about this. I'll be quick because I know your time's tight. Thank you, Candida. Again, the AEW portfolio is in domestic portfolio is in your deck. It is quite sizable. As Seth mentioned, we are able to glean on the ground data that the portfolio produces to really have or generate more conviction on where to invest, both markets and sectors that are performing, but also what sectors and markets to avoid. The firm has one investment committee and risk management committee that I sit on. IC approval has to be unanimous across the committee. The committee sees every investment, whether it's a core investment, an opportunistic investment, or debt origination. The committee has a very long tenure and has worked really closely together through multiple market cycles. We joke it has 2.5 centuries of experience. We do have a dedicated partners team to this fund series. We have significant experience over 20 plus years across multiple market cycles. We have the full resources of the firm to execute the strategy. We have significant sector expertise across the firm and on our asset management teams, as well as a very deep acquisition team across sectors and markets. Here to talk about Fund 10. We have been investing in this series since 1988. Our track record is on one of the pages there. We've been generating risk-adjusted returns throughout market cycles. We really only show the last 6 funds, as those are the funds that I've been associated with the Fund Partners series. We are a lower leverage fund. We call ourselves Opportunity Fund, but our leverage use is in the mid to high 50% range. So we believe that our returns and our leverage use really produces very strong risk-adjusted returns across the fund vintages. All the funds have been profitable. Again, really driving home the sector allocation that's been critical to our return generation. On Fund 10, we do believe that Fund 10 it will be driven by capital market dislocation that we're going into. I think that the financial conditions that we're seeing have tightened really materially. And as we know, real estate is a leveraged asset class. There's a significant amount of distressed capital structures in place right now. And again, we're not investing in distressed real estate. We are looking for investing in distressed capital structures. We believe that real estate in general faces cyclical headwinds that will generate a wide opportunity set for this vintage. With that, there's 3 investment strategies that Seth mentioned that we've actually executed on in previous funds at very similar type capital market cycles. That being loan sales, being repriced core assets, as well as providing rescue capital to partnerships or borrowers. With that, again, sorry about the technology snafu there. Really appreciate your investment and trust in the AEW Partners 9 fund, as well as the board's consideration for the Partners 10. I do want to thank Keith and the team and Seth and the team for the underwriting effort that they put on for Fund 10 as well.
Great. I'm so glad you were able to make it work. Thank you so much. Do we have questions on this investment recommendation from council? Hearing none, do we have a motion? I think the treasurer would like to make the motion.
Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to AEW Partners Real Estate Fund X10 LP, subject to and contingent upon the New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Call for motion by the treasurer, a second by member Lavender. Any discussion on the motion? All right, folks, we are considering a up to $100 million commitment to AEW Partners Real Estate Fund 10. If we could have Andy take a roll call vote on that motion.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 6-0.
Great. We appreciate you folks being on with us.
Thank you again.
Thank you very much. Appreciate
Thank you.
that. Take care.
All right. I'm actually going to skip this next break and just move on. We've got 2 additional voting items to get through. And then I'm actually going to have to leave and I'll turn the chair over to member Lavender at that time. And I think that'll be okay. We won't have a quorum, but we don't have any more voting items. So I think that will be okay, but I'm not sure.
Madam Chair, this is Andy. I apologize. That vote was 7-0.
Okay, thank you. All right, so we're going to go on to agenda item 3G. This is a policy recommendation for our fixed income structure review and recommendation. And we'll start with Vince, and then Vince, you can turn it over to whoever needs to present.
Thank you very much, Madam Chair. So what we have for you here is a structure study. I think it says structure review, but technically a structure study for us. This is a component that we added to the investment process back in 2011. I think it's the first one we did, maybe 2012. And it's a critical component to the total investment strategy. It's just a lot of stakeholders that are involved here with these structure studies. So as you recall, and as RVK often reminds you, that the primary way that we earn our returns is through our asset allocation. So that's not only on a nominal basis. So what probability do we have of hitting our 7% targets for land grant and severance, or for land grant, a little less for severance, but also our relative returns relative to our peers. So academic studies back to the 1970s show that the differences in returns among large funds like us is somewhere between 70 and 90% attributable to our asset allocation. So some of the old studies back in the 70s said 90%. Some of the newer studies are saying closer to 75, 80%. I think that's just an opinion, is that we've added the private asset classes to our asset mixes. Those asset classes have a greater variability of return across the board than the publicly traded asset classes do. But regardless, asset allocation is very, very important. The next step down, though, in generating our rates of return and our returns relative to other funds is the structure of our asset classes. So how we address these markets and what sort of investments we'll make within a given category is the second strongest way that we earn returns. There's a lot of stakeholders involved here. So our strategy group is very interested in understanding the structure of each of these asset classes, because they're the building blocks that we use to build our asset allocations. Our consultants are very interested in those. From RVK's perspective, being able to develop long-term capital market assumptions and risk return assumptions relative to each of these asset classes. They need a thorough understanding of how we'll be investing within each of those asset classes. And our specialty consultants have great interest just knowing the length and the width of the playing field that we're expecting them to address. Our ACDs, of course, our asset class directors are very interested in them. It's their job to be sure they cover their markets broadly and in depth. So they need to know exactly what those should be. Our management group's very interested in overseeing all of that process and giving guidance to those three groups. Our investment accounting group is very interested in how these asset classes are set up. They need to account for the individual investments that'll come into those. Our compliance officer is interested in being able to compare our investment policy to the investments we're making and the structure of those asset classes. And of course, the council very interested in ensuring that their guidance and their policies are being executed in an appropriate way. So these asset or these structure studies for each of the asset classes are very important. So just about everybody that's on the phone has a big interest in what Tom and Nikita are about to take us through. So with those preparatory comments, Madam Chair, let me turn it over to Tom or ask for any questions that you might have on that.
Tom, why don't you start and then turn it over to Nikita? We'll take questions at the end.
Will do. Thank you, Madam Chair, and thank you for that introduction, Vince. So this presentation for the structure study review or structure review, it's going to start on page 445 of your materials. I'm joined for this presentation by Mary Bates and Tad Ferguson from Nikita. I also want to note that RVK provided a lot of helpful counsel on this project. They generated a significant amount of analysis that's included in the appendix. As for background, as Vince said, staff performs structure reviews for each asset class about every 3 years per SIC policy. I joined SIC in May of last year. Took me a few months to get my hands around the portfolio, and then Vince approached me sometime around August to start thinking about any recommendations I would have for the portfolio, any changes I might want to have in the portfolio. Nikita joined the SIC team soon after. And so in October of last year, I traveled over to Portland, Oregon, where both Nikita and RVK are headquartered or located rather, have offices, for 2 days of joint and separate meetings with both RVK and Nikita to discuss the history of the fixed income portfolio and talk about its strengths and weaknesses as well. I need to quickly note the tremendous support that I received internally from our staff, from Nino Carpenito on the history of the portfolio, on our pacing models, the support he gave RVK, or excuse me, the support he gave Nikita, and then in accounting with Nicole Gallegos. She was wonderful in helping me understand what I could and could not do, from an operational perspective. She was great. So, this presentation went through a number of iterations along the way, and I think it lays the groundwork for further improvement and really better oversight. So to start, we're going to take you through a relatively high-level overview, give you a sense of the scope of today's recommendations. In the first part, I'll walk through our recommendations regarding the structure of the asset class. And then in the second part, Nikita's going to step in and they're going to provide a deeper dive into our private debt allocation. And then in the end, we'll come back and summarize all the recommendations that span those two parts. So before we go through the overview, I want to note what today's presentation is not going to do. To what Vince mentioned earlier, we're not going to address targets for the major allocations within fixed income, nor are we going to address SIC's allocation to fixed income. It's a cart and horse thing. RVK and Vince's team, they need to know the structure of the asset class before they can really appropriately model and determine the allocations to fixed income and the major allocations across fixed income. So today, as I've said, is focused on structure and policy. So for my part, which is the first part, I kind of think of it as rearranging the furniture in the house. The house isn't changing, but we are going to move some furniture from one room to the other. So the key part, the key theme in part one is that we're going to be recommending restructuring of fixed income into public markets and private markets. In part two, Makita is going to really delve into observations and recommendations affecting our private credit or our private market investments. This is going to entail a new benchmark recommendation. We're also going to look at revising the groupings of the private credit investments. HAD's going to dig into our commitment pacing needs going forward. And then we're going to highlight some of the investment structures that we're going to emphasize and frankly de-emphasize going forward as well. So for the structural considerations, when Vince asked me to first start thinking about the possible changes to fixed income, my first act before anything was to create a set of guideposts, so to say. I started with a lot of them, but I really distilled them down into this list of priorities for this review. And this part was important to me, and I spent a decent amount of time on it up front. So just quickly, fixed income is one part of a multi-asset portfolio within SIC. We need to strive for clarity and transparency in our investments, our structure, and the naming conventions. We emphasize diversification, but we also want a portfolio that can flex in response to fast-moving markets. And then this one I think is important. SIC is in a relatively unique position in that we are a decent-sized fund, we are liquid, and we are able to digest volatility given our long endowment time horizon. So these attributes, they're valuable, and we should be using them to improve cost, improve oversight, and achieve custom solutions. And then finally, we want benchmarks that are not, they're unambiguous, and they improve your ability as the oversight council and our ability to assess performance. So I hope that as we go through these recommendations, you're gonna be able to see where these recommendations align with, where today's recommendations align with these goals. So just to start, on page 440 is fixed income's current structure. So going across the top from left to right, we'll start with the allocations, core and non-core. These allocations are the major divisions within fixed income. Next are the accounting pools, and this is where participants, whether they be a permanent fund or the city of Rio Grande.
Tom, I don't think that's 440.
Is it not?
Not on my book.
Oh no. Let me see. I'm sorry, 449. My bad.
Well, this item starts on, oh, sorry, 449. Sorry, yep, okay.
Yep, my bad. I can't read my own writing. So going across from the top, left to right, the allocations, core and non-core, they're the major divisions within fixed income. Next are the accounting pools. This is where participants buy into or sell out of exposures. So a participant would potentially buy 50 units of the core bonds pool, and to invest. And in most of the pools, there are at least two strategies. Staff tactically adjust between the strategies, whether it's macro environment related or technical issues such as the participant mix that invest in the pool or the cash needs of the SIC. And then each of these strategies have managers that manage those strategies on our behalf. There are three benchmarks within fixed income. The core allocation is measured against the US Ag. The non-core is measured against two benchmarks. One that is a conglomeration of four indexes, and another that is 3-month T-bills plus 4%. And then there's one accounting pool, the short duration pool. It has a benchmark there's one accounting pool that has a benchmark. Its benchmark is the Gov Credit 1 to 3 year. So that's kind of an overview of the structure. So I'm going to make some observations just for backgrounds to the recommendations that you'll see on the following pages. And I'll go left to right similarly with the observations. So first, the core non-core allocations. Non-core is where our private market strategies and investments are housed. First, SIC's non-core portfolio has grown significantly over the past 5 years, over 70%. Private credit sits right around $4 billion. 50 separate commitments to 34 different managers. And as you'll see when Makita speaks later, we have a robust investment schedule ahead of us. Secondly, the world of private credit has really exploded in both breadth and depth, and is larger than public counterparts in some segments now. So there's nothing non-core about it. It's really core for everybody. The key differentiator now is liquidity. How quickly can we monetize the exposure? And frankly, plus if I'm a stakeholder outside of our circle today, core and non-core means something different to everyone. And we have multi-level use of core in both the allocation names and the pool names. So next are the pools. And I'll start with the short duration pool at the top. In each of those pools that you see on the page, there are at least 2 strategies that allow for tactical adjustments. The short duration pool, it's intended to be highly liquid, but for more permanent monies, there's really no option for a higher return strategy while maintaining very high liquidity. So going down from there, the difference between core and core plus, those accounting pools is additional credit risk going from investment grade to high yield. The duration of those pools really doesn't change. It's the difference is credit risk going from investment grade to high yield. Then we'll go a little further down to the next pool, the non-core or in non-core unconstrained. There's 2 strategy mandates within a subcategory called public market strategies. One is a hedge fund. We'll address hedge funds as a group later. The other is a short duration high yield strategy. It's comprised of liquid investments, mostly high yield, corporate debt, about 90% or so. And then it also maintains an exposure, typically less than 10%, but to widely traded syndicated bank loans. So short duration, high yield, that strategy at one time was in core, but it was pulled down into non-core for the following reasons that were stated at the time. One, it was a better match to pre-existing benchmarks. 2, it was in there as a liquidity option for capital call management, and then as a liquidity option for opportunistic investing. So SIC and the fixed income portfolio, they're highly liquid for the foreseeable future. If fixed income needs liquidity, we can pull it in from core or the public market allocation. It's liquid, so the volatility obscures performance of illiquid private market investments whose returns are really based on cash production and the realization of those investments. And then I'm going to touch on 2 remaining observations that Makita is really going to dive into in more detail. One, that credit and structure pool is where our current private credit investments go. We're going to recommend revising the subcategories to match Makita's taxonomy, which aligns less with structure and more with the underlying collateral exposures. Then we're going to talk about that non-core benchmark or those non-core benchmarks. They include a lot of exposure to public markets and the related volatility. Frankly, they're difficult to use for assessing portfolio construction. And really, as one goes from the public liquid markets to the private illiquid markets, the key costs are transparency and complexity, and they manifest themselves in the form of liquidity or the difficulty of monetization. So to go back to the structure considerations, are we earning enough for that liquidity opportunity cost? So, as we go through the recommendations on the following pages, we'll look at the partition of the allocations and the accounting pools, and then we'll look at how that affects the underlying strategies. So for the first page of the structure comparison, changes that are due to recommendations, they're highlighted in yellow. And again, this page looks at the recommendations for the allocations and the pools. On the following page, we'll go into underlying strategies. So the first recommendation, to better reflect key differentiation today in the fixed income markets and the SIC's portfolio, revise the allocation names from core, non-core to public-private. Second recommendation, to better communicate that the key difference between core and core plus pools is credit risk. So we're going to recommend renaming core plus to credit plus. The third recommendation, eliminate the unconstrained fixed income pool as its purpose is no longer relevant. Fixed income doesn't need a liquidity source from within the private market allocation. Public market volatility obscures private market returns. And Makita is going to more specifically address hedge funds, but they are generally not a fit within fixed income. The fourth recommendation, revise the credit and structured finance pool subcategories as we focus more on underlying collateral. The fifth change is to the current non-core benchmark. Suffice it to say, we want to go from a relatively complicated benchmark, in my opinion, to one that starts with index eligible, widely traded bank syndicated loans, which is a near private, but relatively liquid investment. And it says, if you're going to go beyond this, then you need to be earning an appropriate liquidity premium. In this case, an additional 200 basis points above bank loans. So those are the allocation in the accounting pool recommendations. Let's go to the next page and just look at the strategies real quick. So there's really two things I want to note here. One is the additional strategy to the short duration pool. And then the other is the move of the short duration high yield strategy in with the other high yield exposures in the credit plus pool. So that's my part. That's part one. Before we go on to Makita, are there any questions so far?
Madam Treasurer.
Thank you for this part of the presentation. Real quick, U.S. Core Plus pool changed to Credit Plus pool. Does that change any of the percentages on there?
It may, and that's gonna fall out when Vince and his team and RBK look at some of the strategic asset allocations. So that may affect the tactical allocations between those strategies. But in general, it's going to lower the weighted average duration of that pool. And I have it sort of illustrated in the appendix. But there's really, there's three risks that we have to think about. We have to think about interest rate risk, credit risk, and liquidity. And so the end goal of how we really want to structure things within this overall fixed income is that as we go down in credit quality, we don't want to be adding additional interest rate risk. So it's actually, it's a benefit that we're pulling that in. Frankly, those exposures have always been in fixed income, but by pulling them up into the public market strategies, they're easier to see. They're easier to model. And we're putting the oranges with the oranges and the eggs with the eggs. Does that answer your question, Treasurer Montoya?
It does. And on the next question on the private market strategies, you took out distressed and other. Is that going to fall under special situations?
Well, essentially, and I'll, Mary's going to get into this with their part of the presentation, but there's always going to be an allocation to distressed, and that's essentially, to your point, that's going to fall into special situations. Really, what we're going to highlight on the margin is that category called asset-based, and that that's going to be more. That's going to help us focus a little more on collateral diversification.
Last question on this graph. If interest rates are at a historic high, wouldn't you want to lengthen the duration, going back to the credit plus pool?
So, no, not necessarily. You wouldn't, and as you, so if they're first off, if as you're going down in credit quality, you're adding volatility due to credit risk. And then you're also, if you lengthen the duration at that point, you're also adding volatility. You're adding volatility on volatility. So we want to isolate the two risks. If we want to just take an interest rate risk, exposure, we don't want to do that while being lower in credit quality at the same time. At that point, we can go from the credit plus pool to the core pool, because that's going to have a longer duration.
Madam Chair, it's Vince. If you wouldn't mind, I could weigh in on that too, just a little. So what Tom's talking about here is our structural approach to these markets. So the concern here is, do we have adequate exposure to interest rate risk and not too much exposure to that risk metrics or risk metric. So it's the structural approach. I think what the treasurer's talking about a little bit more is more tactical, and that's left to our managers. That decision is left to our managers. So they work within this structure that we're setting up. So I think what Tom's done here is balance those risks a little bit better among the three risk metrics that he mentioned to you. One of them being the interest rate risk from a structural standpoint. Our managers will make the tactical decisions around that, though, within that structure.
Does that answer your question?
I have one other question. So if credit spreads are tight, why would we increase exposure to credit right now?
So it's a good question. And if you look at many of the if you look at institutional fund flows today, you're seeing that they're generally migrating from high yield to investment grade. So I think you see a lot of institutional active management that's going in the direction that you just mentioned. The fact is, Treasurer Montoya, these exposures have always been in fixed income. Frankly, we're bringing them into the light of day by like I said, putting eggs with eggs and oranges with oranges. So this, to your point, these exposures are there. We're just moving them where we're putting like exposures together so that we can split the liquid markets from the illiquid markets. And then, any tactical allocations will fall out based on the macro environment, either through Vince's tactical adjustments between the individual managers and then the managers themselves making their tactical adjustments based on their assessment of the macro risks.
Thank you.
And then the three drivers he was talking about, interest rate risk, credit risk, and liquidity in the appendix, those are all lined out on page 460 specifically. All right, any further questions for Tom at this time before we turn it over to Makita? Yes, Madam Treasurer.
I'm not sure if this is Makita's section though. Page 456. We wait for Makita on that one.
Okay.
Is that? I'm not sure.
Yeah, I
So
think
that's, you know, that's, so 450, let's see, 455, 456. That's in the appendix. Did you have Treasurer Montoya, did you have a question about any of the current balances or anything like that?
No, I think just if we're changing the titling on those two forms, you'd have to change it throughout, right? All of your other forms, including these?
Correct. And correct. I didn't want to be so bold as to go ahead and make the changes before the council approved them. And then also in much of the analysis that RVK helped with, you'll see through their pages, they go ahead and do a pro forma recombination so that it kind of brings out what the new exposures will be as if these recommendations were enacted or approved.
And on that 200 basis points, is that different from what we currently have, or is that an addition to?
So that is that's something that both that margin is something that both RVK and Makita looked into. You know, frankly, the question to them was, you know, what is an appropriate margin? I can let Matthias, I don't know if Matthias is still with us, but if he's not, maybe Amy, you can speak to the 200 basis point margin. Did I say Mary or Amy?
You said Amy. If it's okay, we actually have a section on benchmarking, and we were planning to address that then.
all right, let's do that then.
Sounds great.
So let's turn it over to Makita.
Okay, great. Thank you so much, and thank you to the trustees. We appreciate that things are running quite long. So Tad Ferguson, my colleague, and I plan to go through this presentation, you know, fairly quickly. Obviously, happy to address any questions today or at a subsequent time. But Tom's already alluded to this. We want to focus on four key recommendations. One, the policy. So the policy benchmark. So we'll address the question that was just raised. Two, the revised strategy allocation framework and revisions with respect to targets. Three, the pacing model and the output with respect to the annual commitment target. And then four, an implementation plan for 2023. But I want to start with kind of the key takeaway from our discussion, and it is more thematic, if you will. What we're trying to do in terms of the revision overall is to design a program that takes into account the unique positive cash flows of New Mexico, one that focuses on yield, downside protection, and recycling. And that emphasis on recycling is incredibly important because, said more directly or more succinctly, what most of our changes are driving to do is to capture the benefits of compounding. So with that, I'm going to start on page 481 of the presentation. I'm not going to reference too many pages in the presentation, but we begin by expressing our support for Officer Lofton's recommendation to restructure the non-core fixed income. And his recommendation is to split the public and private into two discrete programs and to reduce the hedge fund allocation. The rationale for this proposed change is summarized on page 481, which is why I'm referencing it. And the key benefit that we're trying to capture is the ability to better track performance. Why this is because private credit is reported on a lagged IRR or internal rate of return basis. And why that is because it accounts for the fact that capital is deployed over a period of time rather than all at once. So in public fixed income and in hedge funds, the expectation is that you're fully invested at the time of that you're fully invested at the time that the investment is made. In turn, it's appropriate to report on a time-weighted basis. In private credit, you are deployed over time. So that can create very, very meaningful differences between time-weighted returns and IRRs, particularly over short periods of time. So that's why one of the key reasons why we support Officer Lofton's recommendations to split the two, so that we can, on a go-forward basis, report to you on an IRR and on a multiple basis. We also outlined some of the key benefits associated with the revised structure with respect to hedge funds. I know this was discussed previously, but we would reemphasize that hedge funds are a structure. They're not an asset class, and that one of the key benefits of hedge funds is the liquidity provided. And as we'll address multiple times throughout this presentation, New Mexico is in the enviable position of not needing liquidity. Typically, as is the case with hedge funds, you are paying for the liquidity, and we are in a position. You are in a position to actually extract lower fees and better transparency and a better alignment of LP and GPs through the proposed structure that we are bringing forward to you today. So, with that, I would turn to the next page. And I wanted to briefly provide an overview of the revised structure. So again, this is a customized structure for New Mexico that leverages your key strengths, which are your size and your positive cash flows. Many plans of your size are looking for income and looking for yield. You are in the position where what you're trying to do is to minimize downside protection, but to capitalize on the compounding effects of yield. So the changes that we're proposing to the program today focus on that by emphasizing downside protection and emphasizing, this is a subtle point, but an absolutely important point. What we're going to try to do is to recycle your capital as much as possible. So typically in most private credit funds, income is distributed. You don't need that income. You're in the enviable position where you can reinvest that income and benefit from the effects of compounding. What we're going to try to do is to leverage your size in a way so that we're able to design vehicles that are specific to you. That's not going to be the case 100% of the time, but that's going to be another key difference that we're going to bring forward to you. And also something that we're going to do to do that, to design customized vehicles on your behalf, is to allocate commitments that are significantly higher than the commitments that you had presented earlier today on the venture capital side. And we'll talk about why we're comfortable with that, time permitting, given the different risk return profile of private credit. So with that, we're going to dive into the 4 takeaways, the 4 deliverables of this presentation, 1 being benchmark, 2 being strategy allocation, 3 being pacing, and then finally on the implementation. So with that, I would draw your attention to the benchmark and the proposed changes. On page 484 of this presentation, we outline your current benchmark. So you have 2 benchmarks currently, one which is a short-term benchmark that ties to a weighted component, and then the secondary benchmark which ties to T-bills plus 4%. We're proposing today that you move to bank loans or levered loans, that term is used interchangeably, plus 2%. Why do we recommend that? One is because it's a floating rate benchmark, and almost not all, but a high component of private credit is floating rate. And you have a high component of fixed rate exposure in your current primary benchmark. So we wanted to recognize that. Excuse me. We're supporting a benchmark of bank loans plus 2%. Because 2% has historically been in line with the premium associated with direct lending. And you'll see shortly that direct lending is a core sorry, I shouldn't use the word core. I know Tom wants to move away from that, but a large percentage of the allocation in your portfolio. And we have the proof statement in the appendix or in the footnote and more in the appendix supporting that. The other thing is it's the industry's benchmark. There isn't a great benchmark. We fully acknowledge that in private credit, but to the extent that there is a widely accepted benchmark in the private credit universe, it is this. It is bank loans or leveraged loans. We're agnostic to the index provider plus 2%. So that we fully, again, recognize that benchmarking is challenging in private credit, but this is where the industry has moved and has adopted, and so we would recommend that you embrace that as well. So with that, what we were going to transition to, and this is where we had the opportunity during the investment committee meeting to spend quite a bit of time talking about the Makita strategy allocation taxonomy, how we think about and how the return drivers behind the allocations. In the interest of time, what we would look to propose is we would be happy to provide a supplemental education to the trustees and talk through the return drivers and how the cash flows and structures work for the 4 components of private credit as we identify them: direct lending, asset-based lending, special situations, and diversifying strategies. I think we spent close to 30 minutes walking through this on the investment committee call. And so in the interest of time, we would propose is that we offer that to trustees subsequently. But we are making a number of proposed changes, and so we certainly don't want to gloss over anything. But the biggest change that we wanted to do today was to introduce asset-based strategies to your portfolio. To be clear, you do currently have some exposure in your existing program to asset-based strategies. Historically, that had fallen under your structured credit component, but it was one component of a broader structured credit component. So this is a new discrete allocation. We'd be happy to spend time talking through it. And the other thing that's new to this allocation is the diversifying categories. So at a high level, what we're looking to do is to restructure the lending strategies. Those lending strategies going forward are going to be split between direct lending and asset-based lending. We're not getting rid of the distressed and other. That's going to be moving under the special situations category. And special situations is a broader way to look at distress. And then, as I already mentioned, we're going to look to split the structured credit allocation between asset-based as well as diversifying and introduce more exposure to asset-based. And the other key difference that we're trying to do, we're recommending, consistent with what Officer Lofton has already recommended, is to remove that public markets allocation. So I'm on sorry, I don't have that slide number in front of me, but the graph on the table on the left illustrates what your current allocations are, and the table on the right is the proposed.
That's
So
485 to council members.
Oh, thank you so much. Thank you. Apologies for not having that written down. So page 486, that's the slide that we spent, I think, close to 30 minutes on in the investment committee, talking through kind of all of the return profiles of those strategies and the cash flows. And if anyone wants to do that, we'd be happy to do that, or provide in writing to the trustees what the return drivers are on that. But we were thinking we would move past that in the interest of time. And so then what we were asked to do was to map your current allocation to the proposed allocation, which is what we do on the next page. And what we would highlight there is that, well, there's absolutely capacity in all of these strategies, given the strong cash flows of the program. The majority of the changes, as you can see, do tie to the special situations allocations, and where we expect to focus our time and the committee's time in terms of allocations this year are predominantly in the direct lending and asset-based lending, as well as special situations component. So with that, we were going to transition next to the pacing model, which we introduce on page 488 of the presentation. You know, I would highlight, Tad's going to walk us through our pacing model, the output of it. It is a significantly larger commitment amount than had been presented in the 2022 pacing model, roughly twice as large. This probably comes as no surprise, given the significant cash flows that New Mexico has experienced, the meaningful growth that you've experienced at the total fund, as well as some of the restructuring that Officer Lofton has proposed. So with that, I'm going to turn it over to my colleague, Tad Ferguson, who's going to walk through the pacing model.
Thank you, Mary. So just before I walk through the output and the pages, the next couple slides, just wanted to take a second to kind of set the table a little bit on the purpose and background of the pacing model. So the intent of the pacing model is to really determine the annual commitment amount that's necessary to kind of meet and maintain your target allocation to the private credit space. So it's about 15%. And this is a common practice in the private market asset classes, where a large component of the activity is capital committed to closed-end funds that have finite terms or lives and are self-liquidating. That is, as underlying investments are realized, the cash is distributed and returned. So the actual market value within those vehicles declines over time. So, you know, there is required ongoing commitment activity to meet and maintain the target allocation. And the activity this morning that you approved to the private equity and real estate asset class is an example of that ongoing activity. So for our model, you know, we use an industry standard model to incorporate and project these commitment pacings. This was a highly collaborative approach with New Mexico SIC staff. So there's a good back and forth that I think Tom alluded to earlier. But we use our industry standard model. We incorporate market-based assumptions for the target returns of the underlying strategies that Mary outlined. We have assumptions for the rate of investment pace, kind of duration of underlying holdings, and how quickly contributions come back. But it's the annual commitment amount that we really can adjust to achieve the target allocation in a disciplined and consistent manner. And we look to deploy this. You know, we want to have vintage year diversification within the program. So we are striving for a very consistent, disciplined pace to achieve the target allocation over a multi-year period. So the output is highlighted on page 489. And here we are showing the annual commitment amounts over the next 10 years or so. I really want to focus on the first 3 years, where we are looking to deploy 1.5 billion of annual commitments. As Mary mentioned, this is a significant increase in prior modeling, and part of that's due to the restructuring that we're proposing, but also a big component is that larger total portfolio growth. But on this chart, we've got both blue and pink bars. And here we're differentiating between the use of closed-end and open-ended vehicles. And so we are front-loading the use of some open-ended vehicles, and that's really to start off with those larger customized vehicles that Mary's been talking to, being able to negotiate structures and exposures where New Mexico SIC is able to use their size and be able to negotiate customized structures, where we'll be able to have the open-ended nature where these vehicles will be able to redeploy capital and get that MOIC driver that Mary has talked to. So that's why we front-loaded those, the pink bars in the first few years, to get those large, use the word core relationships in the program that will be, stable throughout the evolution of the program. On page 490, we provide a little bit more detail on the underlying cash flows that are outputs of this model. The one thing I can say for certain is that the actual activity will be different in these numbers, as these are just projections. But the key point on this chart that we really like to highlight is that the net cash flow, will be negative as this program is ramping towards its target, where we expect to achieve it in about 2029. So it's a very kind of a longer horizon where we're achieving it in a very stable and disciplined manner. But once it gets up to the target level and becomes more mature and stable, it will become a cash flow generating program. Given the variability of inputs and kind of the changing in market dynamics, we update this annual investment pacing model on an annual basis. And that's and we do different scenario analysis to test different market dynamics. And page 491, we highlight just different total portfolio growth rates, how the different rates will impact the overall total portfolio target allocation. And here we've just, the higher growth rate of 7.4 is the core rate that we used for our original modeling. But here we just show a higher growth rate of 9.4 and a slower rate of 5.4. So in a dynamic where a slower total portfolio growth rate, the private credit portfolio will actually represent a larger proportion, and vice versa for a faster growing total portfolio growth. So if you look at the 2029 time period, we expect to meet the target allocation, in a slower total portfolio growth rate that could be a 17% exposure, or versus a 13 and a higher growth rate. So that's just to show how the different inputs can impact the overall growth of the portfolio. And so that is why we update this annually. We incorporate for the evolution of the overall portfolio, update for market dynamics and total portfolio growth. And the final point on the pacing charts that I'd like to make is that this is just guidance for a target that we strive for on an annual basis, but the actual amount we commit in a particular year will be really impacted by the broader markets and the opportunity set. So we will strive for that 1.5 billion, but the number could be a little bit higher or lower on any calendar year basis.
So Tad, I'm going to interrupt you really quickly to ask our staff on that 489, with that $1.5 billion recommended target annually, how is that different from what we're putting in from our asset allocation percentage right now with this one?
So the asset allocation, I'm sorry, go ahead, Ted.
Well, I was going to say, so we did change the target to, you still had a 15% target to the private credit portfolio. It's just a much larger number because the total portfolio growth rate, I think previous models might have used around 2.5% to 3%. And now, given the recent update to the projections, it's more 7.4%. So the primary driver is just the higher assumption of total portfolio growth, but we're not changing the target allocation to the private credit bucket.
Got it. Thank you. I'm sorry to interrupt. Keep going.
No, I was just actually going to pass it back. So your timing was perfect.
Great. So I'm going to wrap up with an overview of our implementation plan, particularly for 2023. So I'm on page 492 of the materials, and I'm going to keep my comments brief here, where the overall structure that we're going to look to utilize is what we in the industry, I believe, calls a core satellite type of approach, meaning we will have larger allocations to managers and that we view as core. And our bias in terms of commitments to core managers is managers who have the ability to employ a multi-strategy approach within a given vertical. So that's to say, taking asset-based as an example, instead of hiring a large number of managers who have the ability to execute a discrete strategy, we're going to look to partner with a manager who can employ and utilize a relative value approach within that vertical, within asset-based lending. So with that said, we're going to look to diversify the portfolio across vintage year, across strategy, strategy, across geography. And I think what's going to be the change, the emphasis is going to be also on having diversification across collateral. That's one of the key benefits of private credit, is not only having exposure to corporate collateral, but also having exposure to hard assets like equipment leasing, soft assets like intellectual property related assets, etc., exposure to the consumer. So with that ties us to one of our key points for the presentation, which does tie to implementation, and it comes back to commitment sizes. So on page 493 of the presentation, one of the vehicle structures that we are going to look to utilize for some, certainly not all, and this is not appropriate for all for all strategies, nor would we stress that we will look to utilize your size to negotiate customized vehicles when appropriate, utilizing a fund of one structure that allow you to remain invested. And what we mean by this is the structure will be such that you minimize the number of times that you ramp up a portfolio and ramp down a portfolio. You'll remain invested over time, and you're able to recycle your principal as well as your interest, and that should over time improve both your IRR, but most notably your multiple, because you're going to have more capital invested for longer periods of time, and that should be highly additive to your program over time. Also, with fund of ones, you'll have greater transparency as well as oversight. And to be clear, this is not going to be something that we're going to use for all investments, but we do think that ability to improve multiples through fund of one structures when appropriate can be quite additive. To do that, however, you do have to be comfortable making commitment sizes that are maybe larger than New Mexico has historically made. And so to that point, I would draw your attention to the next page where we outline our implementation plan for 2023. Our focus in 2023, as Tad's already alluded to, is going to be on emphasizing more open-ended structures, predominantly through fund of one vehicles, so that we can get capital invested in yield-focused strategies where they're able to recycle. So we have the expectation of doing probably 3 fund of one commitments, and the expectations that all of those commitments will be in excess of $300 million. And we can talk through why they need to be that large on a subsequent educational presentation if you'd like. And then we do expect to continue to make commitments in terms of the drawdown or the term commitment structures as is appropriate. So with that, I'm going to summarize our comments for today. The key takeaway is the focus on designing a program where the emphasis is on yield and on recycling and reinvesting that yield to improve and to generate both an attractive IRR as well as a multiple on invested capital. The 4 key things that we talked about today: the benchmark, we would propose adopting a bank loans or leverage loans plus 2% target. We would propose a new strategy allocation with target ranges of 20 to 40% in direct lending, 20 to 30% in asset-based, 20 to 40% in special situations, and then the remaining 10 to 20% in diversifying. We'd recommend a commitment, or rather we would summarize that we highlighted a $1.5 billion commitment in 2023. And then again, the implementation structure, which will utilize a core satellite type of structure with an emphasis on fund of ones. So again, the key takeaway from our perspective is a revised structure that accounts for the unique cash flows of New Mexico, where the program focuses on yield, downside protection, and recycling to improve the multiple of the program while generating an attractive IRR. With that, I'm happy to take any questions or turn it back over to Tom.
Okay, so this is an incredibly dense presentation. I don't think, at least myself, I was not expecting to make such a broad decision on changing the structure of an asset class like this. So I'm a little bit, this was unexpected, and you know, I do appreciate the commitment of a follow-on education piece that kind of goes more into depth on the fund of one, why they, you know, why you're recommending these particular amounts, and the, you know, the conversation that unfortunately not all of us got to have in the investment committee. I had just a couple of suggestions when we're faced with a decision that is this broad and impactful. If we could maybe, for future recommendations, stretch it out over a couple of different meetings so that we could have materials, presentation, and the discussion, and then give council members a chance to follow up with questions and not take the vote at the same meeting. That's my request for future changes like this. That's number one. Number two, I'm wondering if we could hear from Vince. I mean, I absolutely think that, you know, probably this is something that is unanimous, but like, Vince, what are your thoughts on this pretty profound change?
I think this is one of the better structure studies we've done. Well, first, you don't see anything I don't already agree with.
I figured as much. I just wanted to hear your thoughts on it.
Right, sure. Yeah, not that I put my personal stamp on every single investment you see. The asset class directors have very broad guidelines, and that's all I hold them to. I like some better than the others, but no, from my perspective, this is one of the better structure studies we did. I think the changes that Tom and Makita and RBK are proposing, line up with our broad investment strategy. It's going to be something that's, easier from my perspective to allocate to than our previous structures to a degree. Our previous structures were still good, but I think this is a marginal improvement over those. There's nothing in here, I would say, from the council's perspective that really is controversial or should cause you concern. As Tom indicated, it does give a more cleaner approach, more clear approach to each of the subsections within the market. And that impresses me, or has impressed me as these guys have gone through it. So it's got more transparency. And I think, this is just a big new market, and we've allocated a lot of resources to a lot of our capital to it, mainly with the new funds that have come in. So early childhood education, which is very large now, tax stabilization reserve, I think, has a small piece of this. Just about all of our funds, this is a great asset class. So just about all of our funds we've allocated to this asset class. So I think this one, while it's complex, and I certainly hear you on better education or more education up front before we come with a decision like this. This one is fairly straightforward. And I think Tom's made some improvements over our historic structures.
And Madam Chair, to your point, there is a lot here, and it was definitely a concern leading into this, is that we were going to throw a lot at you, and I apologize that it comes across as so dense, and I do want to underscore that when I want to go back to sort of the guidepost, not sort of the guidepost that guided the goals that guided the recommendations and the prioritization of these recommendations. The goal here is to improve the transparency. The goal here is to be able to, like I said before, put like items together and to make it more easy. I don't know if that's perfect grammar, but to make it easier for you and for other participants in that go along with the SIC to be able, and their advisors to be able to see through as things as simple as the naming and the grouping of existing investments, so they could more intuitively see what risk they were taking on. Things as simple as changing Core Plus to Credit Plus. It emphasizes the fact to a stakeholder, that's the difference. That's the key risk that's being added or lost there. The emphasis on grouping public markets and private markets together. You know, one of the points I made in there is that the ability to model these things easy or easier makes them more, helps us improve the predictability. So really the underlying goal in a lot of this was to allow you as the council members to understand the risk that we were taking and to be able to better assess the performance of our portfolio construction.
Okay, I appreciate those thoughts from you all. And just logistically, so we're changing the name of this portfolio. So is there going to be, are we adding another?
So, yeah, and it goes back to Treasurer Montoya's question before about moving the high yield, the short duration high yield into the Credit Plus accounting pool. That exposure, Madam Chair, has always been there, but it wasn't as clearly identified when it was mixed in with the private credit markets that really are measured on different in a different way. And now it's much clearer for RVK to model it and for us to see those exposures and to adjust going forward.
That makes sense to me. I appreciate that. Thank you. We've got a couple folks with questions here. I'm going to start with Treasurer Montoya, and then I'll go to Member Allen.
Madam Chair, I agree with you. This is a lot. When I read the vote fixed income structure review and recommendations, I honestly thought that was the hedge fund discussion that we tabled that we needed to discuss today, which is part of this, but this is a restructuring of your investment policy. And, you know, to Mr. Vince's comment, it sounds simple to all of you because you invest in this world. I don't. I invest in a different one. And as a fiduciary, I don't feel that I'm being responsible in changing an investment structure and policy when I don't understand the changes in the benchmark. I don't understand. I completely can agree with changing the core to public market strategies and how those first 2 pages, totally can understand and agree with them. But all of these other changes are not only dense, they impact the portfolio in which you have tax dollars, billions of dollars that I don't feel comfortable voting on. Even though I trust all of you are amazing and great at what you do, I can't vote on something that I just don't quite understand and didn't know that this was what we were discussing today. I would go to your investment committee meetings, but they are at the same time as the Board of Finance meeting. So I would appreciate, outside of the recommendation of the chairwoman, to put an educational part and then a vote, or splitting it up in 2, or talking to me outside of the meeting so that I can ask as many questions and not feel that I'm rushed to be able to do that, because I know we're already at 1:15. People haven't eaten. Our brains are a little bit tired, and I know the chairwoman needs to leave as well. So I'm not going to ask any questions because there's just too many of them at this time. Thank you.
I appreciate that. Thank you, Madam Treasurer. And we'll go now to Member Allen.
Same thing. I would like to suggest we have a half-hour educational another day or next week or something, and either do the vote then or do a vote at the next meeting, because this is a lot to take in. And like one of my questions, and you don't even have to answer it now, but I was trying to understand why this means, you know, it's going to be $300 million investments in rather than 100 million or 150. And is that because we're rolling in several investments, or why is that? So I just think that all of us are going to have a lot of questions. And it's right, it's been a really long meeting, and I don't want us to rush this.
Madam Chair.
Yes, Member Messina.
Thank you, Madam Chair. I agree. This is just a little too much right now, and I'm not willing.
We've got 4 members discomfort in voting on this item. I'm wondering, would it be possible? So you promised two things from our folks at Makita, and thank you for all of your great work on this. So a short educational piece, and then the other one answers actually directly the question that member Allen just asked on the Fund of One recommendations to be 300 million. I'm wondering if we could have that background provided for our March meeting, and then if we could postpone this vote till our March meeting. What are the thoughts on that?
Madam Chair, it's Vince. This doesn't pose us any operational issues if you postpone.
All right, so could we have that incorporated into the agenda of our March meeting? Those two pieces from Makita and or our own staff, and then a scheduled vote on this at that time.
Madam Chair, in order to keep this kind of in Robert's Rules of Order, I move we table this until the March meeting,
Great. So
meeting.
We've got a motion, tabling motion.
A
and
second.
Tabling motion from member Lavender, second from member Allen. And we need to take a roll call vote. I'm so sorry about that, folks, but because we are virtual, we can't do any acclamation votes. Member Lavender, did you have something additional?
No, my comment, I realize this isn't debatable, so let's take the vote, and then I do want to say something.
Okay, so let's take a vote on a tabling motion. Andy, and remember, a vote of yes means you vote to table.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
I don't know if we heard you.
Treasurer Montoya.
Yeah, I don't know if we heard you.
Thank you. Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Okay, great. And we very much appreciate all of the work that went into this recommendation. We don't mean by any means to undermine that work. We just want a little bit more time, and we're going to hear now from Member Lavender.
Madam Chair, I think this just really undermines the problem with the lack of council members' ability to go to the investment committee meetings. I think a significant number of these questions would have been answered at that level. I think our presentation was much longer at the investment committee than this presentation has been. And so, asking the staff to do it again is, it's fine. I just think that this underlines that difficulty.
Yeah, I don't necessarily know that we need the entire presentation at our March meeting. I think we need the follow-ons for sure. And this allows council members to ask questions in the intermediate. And I have offered that, Member Lavender, but you did hear that Madam Treasurer actually has a standing conflict with
Madam Chair,
with when that occurs, and she sits on a number of boards. So that's just something that's perhaps we could work around by having her have briefings provided in a different way. Member Messina, did you have something to add as well?
Yeah, I have a concern. If we have too many people, I believe too many council members at the committee meeting, we may have a problem because it would constitute a quorum, or could, and I'm not sure. We need legal counsel to advise about that.
Yeah, we did have this discussion at our January meeting, Member Messina. And so I think at this point, we could welcome one or two more to the committee meetings. What was that? I can't remember what we came up with. Evan?
I think you had 4 on the investment. Any more than 5 is a rolling quorum of the council and potentially runs afoul of open meetings rules and public meeting notices. And
but
so
with the departure of Member Rawson, doesn't that bring us down to 3? He wasn't a investment committee member?
he was. And so now you are at 4. I guess you're at 3, but I need to check that.
Madam Chair?
Yeah.
I'm on that committee and I wasn't able to attend. I had a hearing. So I think we are at 4. I'm not positive, but I believe that's so.
Well, I think with the departure of Member Rawson now, his term ended.
Correct. You're both correct. So you now have 3 SIC members at the investment committee and 1 non-voting advisory member. That non-voting
Who doesn't
advisory
count
member
for quorum purposes.
doesn't count for quorum purposes. Exactly. So you could have 2 additional members of the SIC call in without violating quorum requirements, should you wish to handle it that way. And yes, you're all right.
Yeah, and so I think if you are able or would like to attend a committee, maybe just give staff a heads up so they know that council members are going to be attending. But you know, at this time with that committee scheduled when it is, Treasurer Montoya cannot join.
And I just want to, if I can, Madam Chair, I want to say that I'm more than happy, just like Treasurer Montoya and I had a meeting last month. I'm more than happy to have individual meetings, as many meetings as are necessary. So at your schedule.
That is very much appreciated. Thank you.
Thank you.
Any further discussion on this agenda item?
I think for future reference too, Madam Chair, I think it's also probably really important that if members of the council, after reading the agenda and then reading the materials, have the kinds of questions that we're faced with today, they can certainly contact individual members of the staff or go through Steve or through Vince to get answers to the questions beforehand. And that might simplify things a little bit as well. That's a suggestion.
Guess, you know, if all else fails, definitely reach out to ask. But I have to, you know, echo some of the other members. It wasn't until the presentation began and it became clear, you know, really the breadth and depth of what was in front of us. So yeah, I appreciate folks being willing to postpone the vote until next month. And unless there's anything further, we thank Mr. Lofton and Makita for all of their great work on that presentation. And we'll go next to agenda item 3H, which is a recommended subscription to energy analytics and global data set services from Don Iglesias.
Thank you, Madam Chair. We're going to be on page 501 of the diligent book, and I'll try to be brief in the interest of time. So staff is recommending a subscription to Rystad Energy's shale and upstream data sets, which will also come with access to their analytics services on the oil and gas sector, as well as on the energy transition. So the recommendation is for a 2-year subscription, but I will note that the terms would be on an annual basis, which would give us a chance at the end of the first year to evaluate the service and either cancel or renew for a second year. A little background on Rystad. They are an independent energy research company. They have some of the most comprehensive data sets available on the upstream energy, and they provide on the upstream industry, excuse me, and they provide regular detailed reports on what's going on in the traditional and alternative energy markets. Over 15,000 clients subscribe to Rystad worldwide. Those clients span from energy companies to government organizations, one of which is our very own Department of Finance and Administration, who also subscribes to Rystad. The analytics subscription would give us key insights into the future of energy markets, and most importantly, access to the underlying data sets that will enable staff to better model oil and gas inflows into the land grant, severance tax, and early childhood funds over a 25+ year time horizon. So Vince had mentioned at the beginning of today's meeting that we'll be including a section on inflows in our annual investment plan, and this data will help support that analysis. Also, something that was discussed at our council meeting back in November was the prospect of staff engaging in comprehensive long-range scenario planning, particularly in how different potential outcomes and timing of the energy transition would affect inflows into these funds. So this data would support that analysis as well. And I'll wrap up with just a few comments on why the strategy team is looking to strengthen and improve this process of modeling inflows. So first, Vince had mentioned earlier that the surge of inflows over the past few years, especially in 2022, had essentially blown up our models for estimating those inflows. And so now as a staff, we've been working to develop new models, ones that focus on the underlying factors and economics of what actually drives the revenues into those funds. And as y'all know, good models depend on good data. And so this is the impetus for the recommendation before you. The inflow estimates themselves are a critical component for developing our fund growth projections. It serves as a key input for staff's internal pacing models that guide us in meeting our asset allocation targets, and is a key input for the intergenerational equity studies, and that guides us in balancing the benefits of the funds between current and future generations. And then in addition to that, just having a better handle on our inflows will help us fine tune our liquidity needs and ultimately inform our overall asset allocation decisions. And with that, Madam Chair, I'm happy to answer any questions.
Thank you, Dawn. And for our part at the Land Office, we apologize for being partially responsible for blowing up your old models.
It's a good problem to have, Madam Chair.
Thank you for doing that.
Madam Chair?
Yes, Member Messina.
Yeah, what does this cost?
Oh, absolutely. Sorry, on page 501 of the diligent book. So the average annual cost would be 102,000. So it's 100,000 for the first year with the inflation factor considered for the second year. We are getting a very significant discount as part of not only a state agency, but a bundling of the two data sets that is considerably bringing down the cost from what it would be if we were encountering or engaging in this service as a private company.
Further questions for Dawn?
Madam Chair, this is Harold. This is a tool that I think is really important for us to have. And again, I don't think anybody's really complaining about the fact that our coffers are growing so much. Based on the recommendations of SIC staff, I move that the State Investment Council approve subscription to an energy analytics and global data set service as set forth in the meeting materials and discussed by the council today.
I second.
All right, we've got a proper motion by Member Lavender, a second by Member Allen. Any discussion on the motion before us? Hearing none, we will have Andy take a roll call vote on the recommendation for a subscription to energy analytics and global data set services, agenda item 3H.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Beeman.
Yes.
Madam Chair, the motion carries 7-0.
Very good. Thank you so much for that presentation. We're moving on to agenda item 4, and we'll hear from our audit committee with our committee chair, Member Tejas.
Thank you, Madam Chair and members of the council. We met a couple days ago to review the status of our audit activities, and everything's going according to plan. Really, what we did was we reviewed the budget to actual, the budget that that Brent submits to the legislature, and we looked at budget actual. Everything looks according to plan on that, and in terms of our projections on expenses with our investments, things are looking right in line with what Brent seems to believe will happen through the rest of the fiscal year. Additionally, we reviewed the investment holdings reports and went through that in pretty good depth, and that's really about it as far as the audit committee goes. So with that, Brent, if you have any additional comments on that, go ahead and take it away.
Well, we're gonna hand it over to Brent now for his CFO report, unless there's questions for the audit committee. And I don't hear any. Brent, if you could also just talk about how much of your budget request is incorporated into the current version of HB2, please.
Yeah, sure. Madam Madam Chair, you hit exactly what I was going to speak on. Nick did a nice job there. As everyone knows, we have to put in an appropriation request September 1st, and that goes to the legislature. We come out with two recommendations, one from the executive, which was 99.5% of our request. So we got almost everything that we asked for. And then LFC made a recommendation request of about 99%. The lower of the two requests, which was the LFC request, was the one that was actually selected. That's pretty much status quo. That's how generally it works. I think last year we had an exception where the higher of the two recommendations were actually accepted. I do want to point out, we did ask for 5 additional positions, which would take us from 26 to 31. We, in effect, didn't get the related funding for those positions, but I think we still will have adequate budget to carry on through a budget transfer. Other than that, Madam Chair, I have within the material included not only a budget to actual as of the end of January, but the investment holdings report for January. There's really no comments that I need to make on either of those reports unless there's questions. That's all I have.
Great. Questions for our Chief Financial Officer from anyone on council? Right. Moving on.
And Madam Chair, with that, I'm going to have to leave. I have a meeting here at 1:30. I'm sorry about that.
Okay. All right. We're going to go now to closing matters. Any old or new business before the council?
So I just have a couple of requests. As a good practice, I think that every year we need a report on our cybersecurity practices. And it's also a best practice to have an outside firm look at what we're doing. Increasingly, state agencies are being attacked for ransomware. And I just want to be sure that we're following best practices around cybersecurity. And I know last year we got a written report on it, but it might be a good idea for a future meeting to do that. So that's one request.
And I'm curious, just before you continue with your second request, is the State Investment Council included in that Senate Bill 280 from Senator Padilla on the new security requirements? I don't think so.
Madam Chair, I don't believe so, but we'll follow up and let you know.
Okay.
Yeah, I'm not aware of that, but it would be good if we are. But all I know is in ransomware is 8 times last year, 8 times what it was the year before, and many times cartels and nation states that are doing the ransomware, and they are going after state agencies. So that's one thing. The second thing is long ago, the first time I was on the State Investment Council, we put together a conflict statement. It was something that we wanted all of the members to sign. It never happened that every member, and I'm talking about the members of the council, to sign, but I would recommend that we rethink and relook at some kind of a conflict of interest statement that we as the members of the council sign. It's just another one of those transparency and good governance practices that we might want to follow.
And I'm wondering if that is a discussion that the governance committee could begin. I mean, do we still have a governance committee? Is it?
We do. It's Mike and myself. And so
okay.
We can do that and come back with some recommendations on it. And actually, I have a third thing to think about, given the discussion today and the access we have to these amazing venture capitalists and private equity people. I am concerned that our state have more employment, more jobs, and that there's more investment. Is there a role that the State Investment Council might have in convening experts and entrepreneurial companies in New Mexico to talk about what it's going to take for us to have a real tech economy or a real opportunities. And I know the new fund that we have is to help with that, but should we take a more active role in convening the players together?
Very good. Thank you for all of those recommendations and requests. Anything else from council on old or new business?
I just wanted to thank Mr. Lofton for meeting with me on the hedge fund discussion during the interim. So I appreciate that. And I will be calling you to see if we can meet up again to discuss this last agenda item, second to last. Thank you.
Absolutely, Treasurer Montoya. Be happy to for any of the council members.
I think in addition to the incredible access we have to, investment folks, I think our staff as well and their expertise and backgrounds are great access for us. So I appreciate that. All right. Our next committee meeting is going to be Tuesday, March 28th. I do not know where that will be held. I thought that there were talks about returning to the cabinet room, but I don't know any updates on that. So I think stay tuned on location. All right.
Madam Chair, that's correct. We're efforting that a return to the Capitol. There are still some technical issues we're going to try to hammer out, but we'll keep you in the loop.
Sounds good. And with that, we're going to turn it over to our public comment period, agenda item 6. So do we have anyone in person or that has submitted public comment, Charlie?
Madam Chair, nobody in person. I have one short public email that we received from James Gover. His message is this: thank you for funding a VC firm to transfer technology from New Mexico's research institutions to New Mexico-based startup firms. Does the SIC plan to make any investments in response to the New Mexico EDD, Economic Development Department, strategic plan? I am particularly concerned that New Mexico is not yet leading the U.S. in the transition to renewable energy. That's the end of the message.
Thank you. And just a reminder to folks who may be listening on the YouTube channel, if you're not in person to provide public comment, you can submit that via written form ahead of time to be read during the meeting. Okay. So with that, I'll take a motion to adjourn.
So moved.
Member Lavender.
I second.
And a second from Member Allen. And I'm actually not going to take a roll call vote on an adjournment motion. So we'll see you all in March. Thank you.
All right. Have a good one. Take care.
Bye. Bye, everybody.